Good morning, students. Today, we are going to complete this Ind AS 36 impairment of asset standard. In the last class, students, we have discussed what is impairment, what is the objective of this standard, right? And we understood that impairment is a decline in the value of the asset. And we have also discussed that how impairment is different from depreciation, right? Impairment is more of event based. Depreciation is more of a systematic allocation of depreciable amount over the useful life of the asset. Friends, and in the last class, we discussed the agenda. What is the agenda of this standard? So, of course, the agenda or objective of this particular standard is it ensure that the carrying value of the asset, I mean to say, in the financial statement of a company or in the balance sheet of a company, where the company is presenting the value of the asset, which is a carrying value of the asset, it should not be more than the recoverable value of the asset. It means the balance sheet should be prepared on a conservative basis. When I say conservative basis means if the market value, realizable value, or I would say the value of that asset is 100 rupees, it should not be stated at 120 rupees. Okay. So if it is at 120 rupees, then in that case, the value has been declined to the recoverable value, and then impairment loss is required to be charged, right? At times, student used to ask me, sir, in case the value is 100 rupees, but the company is opting for a revaluation model, in that case, the company is restating the value of the fixed assets or property, plant, and equipment only to the extent of market value, fair value, not beyond that, right? In that case, when the company is opting for the revaluation model, the carrying value and market value becomes same. It is not beyond market value, right? Understood? Understood, or it is not beyond market value, right? In that case, the carrying value and recoverable value become same. Second thing, here this standard only talks about where your carrying value is 100 rupees, but the market value is 80 rupees, right? Or recoverable value is 80 rupees. In that case, you have to reduce your carrying value to the extent of your market value, recoverable value, okay? And that differential is known as a impairment. Friends, we discussed that this standard is applicable on all the impairment. When I say all the impairment, only impairment of assets, okay? Impairment is a negative word, right? So you cannot say that impairment of liability. If liability will be impaired, that is a favorable situation for a company. That is a good situation for a company, okay? So that is why the title is impairment of asset. But there are few standards where the decline in value or the reduction in value, of course, it is an impairment, but it is taken care by the respective standard itself. For example, inventory. In inventory, there is also impairment. Inventory value has to be reduced to the net realizable value, but that impairment is taken care by Ind AS 2 itself. So there are few standards where the impairment is taken care by the respective standard. So this standard will not come into the picture in case of these particular assets. This negative list is given, okay? Otherwise, for all the impairment of assets, Ind AS 36 is the right standard. But the Mool Mantra, which I want to tell you, that this Ind AS 36 is applicable to generally property, plant and equipment, intangible asset, investment property, and goodwill. These are the four primary assets on which this standard is applicable. Impairment loss, now we have understood if your carrying value in the balance sheet is more than your recoverable value, then the impairment situation will arise and you have to book the impairment. We discussed the meaning of recoverable amount. This is the same meaning which we have learned in AS 28, which we have already know, which we know that this higher of fair value less cost to sell and value in use is known as recoverable amount. Fair value less cost to sell means if you want to sell the asset in the market, what value you will fetch after deducting the cost of sales. Value in use means if you will use the asset till the lifetime or till the economic life of the asset, what is the net cash flow you will receive from using the asset plus terminal value of that asset, scrap value of that asset. If you will discount the future cash flows, when I'm saying future cash flows, I'm talking about your inflow as well as outflow. For example, if you are into a car rental business, right, and you are doing an assessment of impairment of your car fleet, in that case, let's say the life of the car is 10 years, so you will have a cash inflow over a period of 10 years by leasing or renting your car. Okay. But at the same time, by earning these rentals or earning this lease income, you will have some cash outflow as well. For example, fuel expenses, driver salary, maintenance of the car, right? So these expenses has to be netted off from the cash inflows, and then you have to compute the value in use. So value in use is nothing, it's a present value of future cash flows. Okay, where future cash flows is cash inflow minus cash outflow. If your asset will fetch some terminal value, so that terminal value which is at the end of the economic life or useful life, that terminal value is also going to be discounted and taken in the value of the and taken in the calculation of the value in use. Okay, so this is one of the small case study we did. Then we discussed that whether every asset impairment testing has to happen on every period end. So then we discussed you need to identify whether an asset impairment testing is required or not required, right? So at the end of each reporting period, the company needs to identify whether there is any indication of impairment. If yes, the indication of impairment is there, then you need to estimate the recoverable amount. Okay. So this is an indication of impairment. Okay. So what could be the indication of impairment? There are some internal indicator or there are some external indicator. For example, at the end of the year, you found that your machinery got damaged, right? There is a physical obsolescence or your machinery got damaged. In that case, it is an internal indicator of impairment that you have to reassess your recoverable value. Or like if I talk about 3-4 years back, so everyone used to use the Tata Sky or that Airtel TV, right? But nowadays, even in my house, there is no Tata Sky. The connection is there, but I am not doing the recharge of this Tata Sky at all. So what is happening in this case, the technology which is Tata Sky is again this, there is a technological changes, there is technological obsolescence. Okay, so now people are using OTT because the internet become very cheaper and everyone is using OTT. Even if you have to hear the news, so you can just watch or hear the news by in the OTT. Okay, so friends, this is a technological changes. Like more of phones are Android phones. Earlier the keypad phones were there, right? Again, it is a technological changes. Camera, that camera technology has become obsolete. Earlier you were using that what would I say? That small camera, right? But nowadays everyone is using their mobile phone for clicking the photographs. If you have iPhone, if you have good Samsung phone, OnePlus 10, OnePlus 11, so the picture quality is much more or much better than whatever the picture quality of the camera is there. So friends, these are the indicator of technological obsolescence. Okay, or the government has banned some output, the government has banned some product. So again, it is an external indicator of assessing the impairment, doing the impairment testing and computing the fair value less cost to sell and value in use, right? Okay, friends. So this is what we discussed, but you remember we discussed three exceptions, that in case of three assets, you are not required to check whether the impairment indicator exists or impairment indicator does not exist. What are those three assets? Salesh, Vansika, Viraj, Tanisha, what are those three assets? What are those three assets where, irrespective of the indicator, you are required to do the mandatory impairment testing? You're absolutely right, Neha. It is intangible asset. All three are intangible asset. One is intangible asset having indefinite life. Second, intangible asset not yet available for use, means under work in progress stage. Number three, goodwill arising in business combination. These are the three assets. These are the three assets, three intangible assets where you are required to do the impairment testing irrespective of the existence of indicator. Even though indicator are not there, still you are required to do the impairment testing for these three assets. Okay, very good. So these are some internal and external indicator we discussed that day. Then we discussed the meaning of recoverable value, right? We discussed the meaning of fair value and cost of sales. Cost of sales means which is a directly incremental cost to bring an asset into condition for its sale. Okay, like we discussed, valuation fee. Valuation fee is not a cost of disposal. It is not a cost of sale. Valuation fee is not a cost of sale, right? It is not bringing the asset into the sellable condition. But if you're dismantling the asset for the sale, it is necessary to bring the asset into the sellable condition, right? Value in use, it is a present value of future cash flow. You need to estimate your future cash flow and you need to estimate your discount rate. In case of estimation of future cash flows, you need to consider the cash flow only derived from that particular asset, only derived from that particular asset. Okay, you need to consider the time value of money, the timing of arising of cash flows, right? Then you need to have some reasonable and supportable assumption that what you are expecting to receive in future from that asset. If there are some external evidence like some contracts are there for future cash flows, so you need to give more weightage to the external evidence. Okay, you need to refer your most recent financial budget or forecast which have been approved by the management, and the projection which you are taking for future cash flow, it should be for a maximum period of 5 years unless a longer period can be justified. For example, if there is a aviation industry, if there is a aviation company, right, and aviation company life of aircraft is 20 years. Okay, so the cost of the aircraft is too high, it is like 300 crores, 400 crores. Okay, so if they will make a projection of next 5 year only, probably they will be into the losses, they will not be able to recover the present value of the future cash flows on 5 year basis. It is of course lower than the carrying value of the asset because the life is 20 years. In that case, probably this company will make a projection of more than 5 year. Why? Because the life of aircraft is not only 5 year, it is 20 year. Okay. So normally you have to take a projection for 5 year, but if the longer period is justified, you can go for the longer period. This cash flow include the cash flow should be estimated for asset in the current condition. Okay, so it means if you are expecting that after 3 years my economic condition will be much better, and in that case I will be able to generate more cash flows, so your cash flow should not be estimated in that way. The cash flow should be estimated in the current condition only. Okay, cash inflows from the continuing use of the asset. So whatever inflow you will use from the using the asset, and whatever outflow which you are incurring for earning this inflow. And the last one is the terminal cash inflow. Okay. Your discount rate is nothing. Your discount rate. So this cash flow part we have discussed. Discount rate is a time value. It is important to assess the time value of money, and this discount rate is specific to the asset. So what could be the discount rate to be used? If in the question weighted average cost of capital is given, so that is the first thing which you need to take into consideration. If weighted average cost of capital is not given but incremental borrowing rate is given, so you can give the second priority to incremental borrowing rate. If incremental borrowing rate is not given but the market borrowing rate is given, for example, the question is demanding you to check the impairment for 5 years, and it is saying that the market rate of interest for 5 years is, let's say, 10%. So you need to take then market borrowing rate. Okay. Then we discussed what happens in case of foreign currency future cash flow. For example, your asset is lying in the foreign currency, in the foreign location outside jurisdiction. In that case, you have to follow 3 steps. Step number 1, even you have to follow 4 steps, I would say. What is your 4 steps? Step number 1, compute your cash flow in the foreign currency. Okay, compute or estimate your cash flow in the foreign currency. Number 2, estimate the discount rate applicable to that country or applicable to the foreign currency, right? Number three, you need to calculate the value in use, the present value of future cash flow, foreign currency cash flow in the foreign currency only. So now you have a value in use in the foreign currency. Now you need to apply the spot rate for converting this foreign currency into the Indian currency. Okay. So this is how you will estimate the value in use for the foreign currency cash flows, right? For the assets which are lying in the foreign currency. Friends, this is what we have covered in the last class. Okay. Now we are taking it forward from this particular position. So now we will discuss a comprehensive case study on impairment loss, right? Where the depreciation calculation will be there, the value in use will be there, the fair value less cost of sale will be there, right? And the revised carrying value will be there, right? So we will discuss this comprehensive case study to understand our concepts in a more detailed manner, right? Please do let me know if you have any question. Please do let me know if you have any question relating to the last class or relating to whatever in the last 15 minutes, whatever I have covered for the last class. Thank you, Shruti. Thank you for this nice feedback. All clear? Very good. Let's move on. And please concentrate on this case study. Mars Limited gives the following estimates of cash flows relating to property, plant and equipment. On 31st March 2004, the discount rate which is given in the question is 15%. The question has given you the discount rate, and this question has also given you the estimated cash flow as on 31st March 2004. The company is expecting 2000 lakhs of cash flow in the next year, which is 4-5, in 5-6 3,000, in 6-7 again 3,000, in 7-8 4,000, in 8-9 2,000, right? So these are the cash flows which are given for the 5 year from the continuing use of the asset. Residual value at the end of the life of the asset is 500 lakhs, and the terminal cash flow is also given. This is the regular cash flow which is given, and this is the terminal cash flow which is given, right? You remember that capital management concept, budgeting concept, capital management concept. Property, plant and equipment was purchased on 1st April 2001 for rupees 20,000 lakhs. What is the cost of this property, plant and equipment? 20,000 lakhs. The useful life is 8 years. What is the useful life? 8 years. What is the per annum depreciation? Shruti, what is the per annum depreciation? Neha, what is the per annum depreciation? If cost is 20,000 lakhs, which is 20,000, useful life is 8 years. So 20,000 divided by 8. But in this question, there is a residual value which is given at the end of 8 years, which is 500 lakhs, right? So what is the formula of depreciation? Cost minus scrap value or residual value, cost minus residual value divided by useful life. So 20,000 minus 500 divided by 8. What is the per annum depreciation? What is the per annum depreciation in this case? 20,000 minus 500 divided by 8. What is the per annum depreciation? Can anyone tell me the per annum depreciation, guys? 2437.50. 2437.50. Okay. Okay. Thank you, Tanisha. So this question is talking about 31st March 2004. This asset was purchased on 1st April 2001. So first of all, you need to compute the carrying value of this asset on 31st March 2004. If this asset was purchased on 1st April 2001, it means 1, 2, 2, 3, 3, 4. You need to compute the accumulated depreciation for a period of 3 years. Okay. And then when you will reduce this 3-year accumulated depreciation minus gross block minus cost, it will give you the carrying value of the asset. It will give you the carrying value of the asset, right? So let's see what is the carrying value of this asset on 31st March 2004. Original cost on 1st April 2001 is 20,000. Less depreciation for 3 years. 20,000 minus 500 divided by 8 into 3. 7313. Your carrying amount as on 31st March 2004. Carrying amount as on 31st March 2004 comes out at 12,687. Clear? So we got the carrying value as on 31st March 2004 for this property, plant and equipment. Now I need to do the impairment testing. I have to compute the fair value less cost to sell, and I need to compute the value in use. In the question, the fair value less cost to sell is given in this question. It says that the fair value less cost to sell is 10,000 lakhs. My carrying value is 12,000 something lakhs, but my fair value less cost to sell is 10,000 lakhs. And in the question, some cash flows are also given. Discount rate is also given. So I need to compute the value in use. Can I compute the value in use? If all these information are given, can I compute the value in use? Yes, of course, I can compute the value in use. So now what I'll do, 15% is a discount rate. What is the present value factor for the first year? 1 divided by 1.15 will be the discount rate for the first year, right? So this is the calculation of value in use. This is the years I have plotted. And in 8-9, there were two cash flow. Number one, from the continuing use and the terminal value cash flow, which is 500 lakhs. Okay. So in this question, the regular use and terminal cash flow have been clubbed. The regular cash flow was 2000 lakhs and terminal cash flow was 500 lakhs. Right, friends? If you want to show it separately, you can show it separately as well. Okay. So this is the present value factor. So I have computed the present value factor for every year. How you will compute the present value factor? 1 divided by 1.15 for the first year. Then when you will divide 0.869 divided by 1.15, you will get the cash flow for the second present value factor for the second year. So on and so forth. You will get the respective present value factors. This is your total present value of the future cash flow. This is coming out at 9,510 lakhs. Your carrying value is 12,687 lakhs. Value in use is 9,510 lakhs. Your fair value less cost to sell is 10,000 lakhs. Friends, tell me what will be the impairment loss in this case? Tell me what is the impairment loss in this case? Your fair value less cost to sell is how much? It is 10,000 lakhs. What is your value in use? Your value in use is 9,510 lakhs. So what is your recoverable value? It is higher of fair value less cost to sell and value in use. What is higher? 10,000 is higher. And what is your carrying value? It is 12,687. So 12,687 minus 10,000, 2,687 is your impairment loss. 2,687 is your impairment loss. Whether anyone have any doubt in this? Right? So this is what it is given. Your value in use is 9,510. Fair value less cost to sell 10,000. Recoverable value 10,000. This is your recoverable value, right? And your calculation of impairment loss, carrying value minus recoverable value, 2,687 is your impairment loss. Friends, do let me know if you have any doubt so far. No? Very good. Now you need to calculate your revised carrying amount. Your revised carrying amount will be the 12,687 minus impairment loss. 10,000 is your revised carrying value because you have booked an impairment loss of 2,687 lakhs. Now the life of the asset is 8 years. 3 year has already moved out. 3 year has already completed. So now 5 year is still to go. 5 year are still left. So now whatever is the revised carrying value, this has to be depreciated over the period of next 5 years. So how to compute the future depreciation? Revised carrying amount is 10,000, but you will get 500 lakhs as a residual value. So 10,000 minus 500 divided by 5 is equal to 1900. So the revised depreciation is 1900 lakhs, which has to be charged over the period of next 5 years, 1900 lakhs every year. Friends, the revised carrying value, how do you compute the revised carrying value? Your last carrying value minus impairment is revised carrying value, right? This is your gross block. This is your gross block. Now you have to compute the depreciation. So out of this gross block, you will receive 500 at the end of the at the end of the life of the asset as a residual value. So your depreciable value is your gross block, which is revised carrying value minus your residual value. I am only deducting this residual value for computing the depreciation. Why? So that at the end of the useful life, my net block will be equal to my residual value, right? So in this case, after 5 years, my net block will be 500 lakhs. And of course, my residual value, which I'm expecting as of now, is also 500 lakhs, right? Viraj, Kusum, Shruti, Aparna, Vansika, all clear? Clear in mind or clear from mind? Clear in mind? Okay. Yes. So friends, this impairment loss we discussed now, we understood now that what is meant by impairment loss. Now friends, I am just asking you a situation, right? And in the last class I have discussed, one of the student was asking, sir, what is your tips or what is your key pointers while appearing in examination? I told you that please give more importance to the concepts rather than to the that rotification learning. Okay, so you guys have already understood Ind AS, Ind AS 16 property, plant and equipment, Ind AS 38 intangible asset, and Ind AS 40 investment property. If a company has opted for a revaluation model, right? Please write down on your notebook. Please write down on your notebook, and let me uh, open my Excel file. Please do let me know if my Excel file is visible. Please let me know if my Excel file is visible. I hope it is visible. Let's say example. A Limited has a carrying value of machinery for rupees 10,000. The company has opted for a revaluation model and the fair value comes out at rupees 15,000 at the end of next year, right? The fair value post this year comes out at 12,000, right? Please suggest how this impairment loss will be treated. So friends, let's assume that on 31st March, I'm just assuming on 31st March 2020, let's say, right? What was my value of the machinery? My value of the machinery was how much? 10,000, right? I'm just assuming. In the next year, that is on 31st March 2021, my value of the machinery gone up by 15,000. It is gone to 15,000. So there is an increase. There is an increase of 5,000, right? Where this increase will go? This increase will go to the revaluation surplus in other comprehensive income, right? You all agree with this concept? You remember this concept in Ind AS 1638-40? Ind AS 1638? Yeah. On 31st March 2022, again, what happened? On 31st March 2022, the value of the machinery has gone down. There is an impairment. It has gone down to 12,000. There is a decrease. There is a decrease of 3,000. What is the treatment of this decrease? What is the treatment of this decrease, guys? What is the treatment of this decrease? Whether it will be charged to P&L, whether this decrease needs to be charged to P&L. Rahul is saying that this decrease has to be adjusted to the revaluation surplus because we have revaluation surplus of 5,000, right? This is what we have read in Ind AS 16. This is what we have understood in Ind AS 16 and 38. All agree with Rahul's statement? All agree or not agree? Guys, what is your view? Yes, yes. So this 3,000 has to be adjusted from revaluation surplus, right? 3,000 to be adjusted from revaluation surplus. It should not be charged to the P&L. It has to be adjusted from revaluation surplus. Okay. So friend, standard says that whatever impairment is there, it has to be charged to the P&L. But if the company has opted for a revaluation model, in that case, if any amount is left in the revaluation surplus, the decrease has to be adjusted from the revaluation surplus. If the decrease is beyond the revaluation surplus, that additional amount has to be charged to the P&L, right? For example, extending this example further, extending this example further, for example, on 31st March 2023, the value of the machinery has gone down to 9,000, or let's say 8,000. How much decrease is there? Again, there is a decrease of 12 minus 8, 4,000. Guys, what to do now? Please tell me. What to do now? What to do now? Tell me quickly. Yes, this 2,000 has to be adjusted because there was a 5,000 of revaluation surplus. 3,000 has been adjusted. So 2,000 adjusted from revaluation surplus, and balance 2,000 to be charged to profit and loss, P&L, right? The balance 2,000 has to be charged to the P&L, right? And this is how this accounting entry has to be done. Machinery needs to be credited. So what is the accounting entry in this case? Revaluation surplus, OCI account debit, right? Your profit impairment loss, P&L account debit, to machinery account credit, right? 2,000 and 4,000. 2000, 2000 and 4000. Is that clear, friends? Is that clear? I hope it is clear to all of you. Yeah. Let me again go back to my presentation. So this is what it is written there. Impairment loss should be recognized immediately in profit and loss unless the asset is carried at revalued amount. In that case, the impairment loss of a revalued asset should be treated as a decrease in revaluation. So whatever revaluation surplus you have, first of all, adjust your impairment loss from the revaluation surplus, and then you need to charge it to the P&L if additional loss is there, right? And whenever you will charge your impairment loss, your of course asset value has to be revised, it has to be reduced, and the future depreciation is on the basis of the revised asset value, revised carrying value. This is what we have discussed just right now, in that case where the revised depreciation is on the basis of the revised carrying value. Okay, your deferred tax asset or deferred tax liability has to be determined in accordance with Ind AS 12. Have you guys covered Ind AS 12 income taxes standard? Have you guys covered Ind AS 12? Yeah. Whether you guys have covered Ind AS 12? Or that standard is yet to be covered? Is it covered or it is yet to be covered? Okay, not yet. Okay. So friends, this deferred tax asset and deferred tax liability, of course, it has to be determined as per Ind AS 12 in case of an impairment. Why? Because normally income tax does not consider impairment, right? Income tax only consider the depreciation. Okay, income tax says that this impairment is a notional concept. So your book value and tax base has to be different, right? So when you understand Ind AS 12, you will be understand about deferred tax asset and deferred tax liability concept. So that is why standard says that it has to be determined as per Ind AS 12. Okay. And you remember when I have started this standard, I told you that we'll talk about two things. Number one, we'll talk about the impairment of individual asset, and we will talk about the impairment of group of asset. The impairment of group of asset. How many of you remember this discussion? How many of you remember that I have told you these two things? How many of you have remembered this thing? Guys, please tell me how many of you have remembered this thing. Rahul is saying yes, sir. Neha is saying remember, sir. Okay. So far, I only talked about impairment of individual asset, where you need to compare the carrying value of individual asset with the recoverable value of the individual asset, where you need to compute the fair value less cost to sell, where you need to compute the value in use of that individual asset, right? At times, the market value of the individual asset is not available, or the value in use of the individual asset is not accessible, right? In that case, the question comes that how to compute the value in use or fair value less cost to sell of that individual asset. If it is not determinable, then how will you do the impairment testing? How will you compute the recoverable value? How will you assess the impairment loss? You can't do that. In that case, standard says that if the determination of recoverable amount of the individual asset is not possible, then you need to compute the recoverable value of the group of asset. And what is the meaning of the group of asset? The meaning of the group of asset means it is the cash generating unit. The group of asset, the name of the group of asset in this impairment of asset standard is the cash generating unit. And what is meant by cash generating unit? Cash generating unit means CGU, means it is a smallest identifiable group of asset, which can generate cash flow independently from the other assets, right? So friends, I'll take an example to make you guys understand this concept. Friends, there is a machinery A. This is a machinery A. Okay. This is a machinery B. And this is a machinery C. These three machineries, A, B, and C, are used to manufacture a cold drink. Are used to manufacture a cold drink, right? Cold drink. These three machinery used to manufacture a cold drink. CD means cold drink. Now, this machine A, in this machine A, the water, the other, pesticides, chemicals, or whatever is there. So these things will be stored in this machine A. Okay. And this machine A mixes this material. This machine A mixes this material. And this machine A pass on this material to machine B. Machine B will do some, machine B will do some processing, right? So that this mixed water will get a form of, a cold drink. Like this machine B used to put some fizz in that water, or in that, I would say, in that solution, liquid solution, right? So this machine B is processing that mixed solution, and it is making it like a cold drink. Okay. Then this entire liquid is passed on to machine C, and machine C stored that water into a bottle, stored that liquid solution into the bottle, and make it like a cold drink for a sellable condition, right? And make it a cold drink into a packed bottle where the fizz is there. Fizz means, when you open the Pepsi or open some cold drink, there is a I would say there is a vapor, or there is a fizz. Okay. So basically, if I talk about A, B, and C, right? When these three machines put together, then only they are able to generate an output, which is a cold drink. Okay. This machine A individually cannot generate an output. This machine B, without support of A and B, cannot independently generate an output. This machine C cannot independently generate an output. Or this machine C, let's say it is only a packing machine. It is only a packing machine. For example, this machine C can generate an output independently also, right? Because this machine C work is only packing, only packaging and packing. But of course, for manufacturing a cold drink, this three machine is required. This three machine is required. Friends, now what happens if you have to do the impairment testing of machine A? You will not be able to compute the value in use. Why? Because this machine A independently does not have any value in use. So whatever this machine A is producing, the output is not sellable, right? So how will you compute the future cash flows? This machine B independently does not have any value. Whatever this machine B is producing, the output is not sellable, right? Whatever this machine C is doing, again, independently does not have any value, right? Because this machine C will only be able to pack the material if it is supplied by A plus B. So friends, when this machine A, B, and C put together, then only they are able to generate an output which is sellable in condition, which is a sellable, and where the cash flow can be arised, right? So if independently A, recoverable value cannot be determined, B cannot be determined, C cannot be determined, in that case, we need to look at the smallest group of identifiable asset who can generate cash flow independently. So these three machines put together can generate the cash flow independently. These three machines put together can generate the cash flow independently, right? So this is known as a smallest identifiable group of assets which can generate cash flow independently from the other group of assets. So this is known as a cash generating unit. In this case, the recoverable amount of this group of asset needs to be determined. The recoverable amount of this group of asset needs to be computed, needs to be assessed, needs to be calculated, and then it needs to be compared with the carrying value of this group of assets, and whatever impairment loss is there, it has to be allocated to the machine A, B, and C. To the machine A, B, and C. Right? Sir, how do we allocate that? We will discuss it later on. But have you understood the concept of machine A, B, C? I mean to say concept of cash generating unit. Let's say this machine C value in use can be determined, or fair value less cost to sell can be determined, let's say, right? Sir, in that case, can I compute the machine C recoverable value? You can compute, but in that case, standard says that if the recoverable value of one asset can be determined independently, but if some other assets which are attached to this asset, these assets like A and B, the value of this A and B cannot be determined independently. The value of this A and B cannot be determined independently, right? This A and B value cannot be determined independently. In that case, standard says that this A and B needs to be clubbed with C. This A and B needs to be clubbed with C, and then they will form a cash generating unit. So my dear friends, in the group of assets, there may be one asset or two assets where their recoverable value can be estimated independently, but since some other assets are not able to independently generate the output, that is why these other assets are grouped with this particular asset, so that this entire group will have a cash, will become a cash generating unit, and will be able to generate the outflow or inflow, will be able to generate the cash flow independently, right? Whether the cash generating unit concept is clear? Is it clear or not clear? Clear? We'll discuss one more example to understand this cash generating unit concept. A bus company provides services under contract with a municipality that require minimum service on each of 7 separate routes. So there is a bus company, and like in Delhi, there is a DTC. Okay. So this bus company XYZ Transport Limited wants to run its buses on the street of Delhi. So this bus company provided services under a contract with the municipality, and the municipality is managing this entire thing. And municipality says this bus service that you have to operate on the 7 separate routes, So friends, 7 separate route, if they have to operate on the 7 separate route, means one thing is very clear, the 7 separate buses should be there. Am I right? 7 separate drivers would be there, 7 separate conductors should be there, the revenue should be separate, the fuel expenses is separate, it is related to each and every bus. So the asset is separate, the inflows are separate, the outflows are separate. Are you all agree with me? Are you all agree with me, guys? Speak quickly if you agree with me. Whatever I am saying, that the asset, inflow, outflow, everything is separate. You all agree with me? Yeah? Okay. Agree with me. Very good. Now let's discuss further. Asset devoted to each route and cash flow from each route can be identified separately. This is what it is written in the question also. One of the route operate at a significant losses. For example, this bus company is operating the bus into the 7 separate routes. And what happens? One of the route is into the significant losses. The route number 1, 2, 3, 4, 5, 6, and 7. So all the routes are in profit, but this one route is into the losses, right? Heavy losses. Should the company determine the recoverable amount for an individual asset or a cash generating unit? Since one of the route is in the losses, so there is a cost attached to it. I mean to say there is a separate bus attached to it. So now the question is whether this company should assess the impairment loss only for this separate route as an individual asset, as this bus as an individual asset, or the company should assess the impairment loss for this entire 7 buses, entire bus company or entire 7 buses or entire 7 routes put together as a cash generating unit. Have you understood the question? My question is, on the 7 routes, the 7 separate assets are there. 7 separate buses are there. So my simple question is whether the route which is into the losses, it is having a separate bus. So whether the company needs to assess the impairment on an individual bus on an individual asset basis, or the company should assess the impairment for this entire 7 routes as a group of assets, this entire 7 buses as a group of assets. What is your view, guys? What is your view? Tell me your view. Then only I'll proceed. This question will clear your concept that how to think about this. If you will ask me, sir, whether the separate bus is there, answer is yes. Separate bus is there. Whether the cash flows are separate, answer is yes. Cash flows are separate. The bus has a value. But the point is the value in use. Can the value in use be assessed or should be assessed for this route separately, or it has to be assessed as a cash generating unit, putting the entire 7 routes together? Nisha is saying each of the buses operates separately, so they need to assess them individually. Abdul is saying CGU wise. Geeta is again saying CGU, which is a group. Neha is saying as a group. Rahul is saying as a group of assets. So the guys who are saying, so Anisha, what you are saying, I understood, because you are saying, sir, separate routes are there, separate cash flows are there, separate buses are there, then go individual. But majority of the guys are saying CGU wise, means group of asset concept wise, means they are saying you are not required to assess the impairment on an individual asset basis. You have to assess the impairment on a group of asset basis, right? So my question was, if you are saying that group of asset, then why you are saying this thing? What is the rationale behind that? What is the rationale behind that? Friend, first of all, the contract is with the municipality. The contract is with the municipality. And what is the contract? The contract is to that require minimum service on each of 7 separate route, right? So this 7 separate route has given as a single contract. That is number one, right? Friends, if the company has this single route which is into the losses, can the company avoid this route? Can the company avoid this route? Tomorrow, can this company say that no, I want to operate only on the 6 routes which are into the profit, and I'll not operate this single route which is into the losses? Can the company say that contractually? Of course, answer is no, because the contract is they have to operate the minimum service on each of these 7 routes. That is a minimum contract. So this company, this bus company will operate this loss-making route. Why? Because they are getting huge profit from the other 6 routes. It means they are considering the profitability as an entire bus company. What happened if they would have incurred majority of the losses or losses on the every route? In that case, whether they will operate, answer is no. But here they will operate. Why? because they are not considering, or they are not taking the cognizance of this single route only for the purpose of assessing profitability. They are losing on one route, but they are earning on the 6 routes. It means they are looking the profitability more from the single contract basis. And friends, even I can say that due to the single loss making route, they are able to make the profit on the 6 routes. If they will stop this single route, they are not allowed to operate on the another 6 routes as well. Don't you think so? Don't you think so? Yeah. If a student who score 50, right, or if a student who will fail in one paper, and of course in other paper exemption is not there, a student who failed in one paper, and in the remaining 3 paper he scored 50, 55, 58, right, he failed in one paper, whether the group will fail or only that paper will fail, whether he will fail in the entire group or whether he will fail in that paper only, he will fail in the entire group. Am I saying right? Am I saying right? Yeah. And like in this case, this 7 routes has to be seen as a single route. Single route means single contract. Okay. Probably due to this loss making route, due to this loss making destination, the company is able to make the profit in other 6 destinations. Right. So in this case, the smallest identifiable group of asset is not a single route, a single bus. It is the 7 buses put together. Right. So the company needs to compute the recoverable value for this entire 7 buses put together, and company needs to compare the carrying value of these buses, 7 buses put together, with the recoverable value of 7 buses put together. If the recoverable value is lower than the carrying value of the group of buses, in that case impairment loss will be there, and now this impairment losses needs to be allocated to all these 7 buses. Sir, how? I'll discuss. Shruti is saying, so Muhammad Abdul is saying, sir, substance over form. You are right, Muhammad Abdul. So Abdul, you are bang on. You are right. It is a concept of substance over form. Shruti is saying, sir, if bus is traveling from CP to South Delhi, Connaught Place to South Delhi, in between some route is loss making, so that route can be avoided by the bus. Shruti, I'm not saying about the patches. I'm not saying about the patches. I am talking about the destination, like from Shahadra to South Delhi, from East Delhi to South Delhi, from East Delhi to North Delhi, from East Delhi to West Delhi, from South Delhi to North Delhi. So I'm talking about these destinations, right? I'm not talking about the patches in between. Okay. So that bus will not take the route from Karol Bagh, the bus will take the route from, let's say, Dhola Kuan. I'm not talking about that, right? I'm talking about the entire destination, that particular bigger route I'm talking. Tanisha is asking, sir, had there been a case where the company contracted with different parties for each of the 7 routes, then still the answer remains the same when it comes to CG or individual asset? No. Tanisha, in that case, this contract is not with only one party. And in that case, the contract is not to operate a minimum on 7 route. The contract was to operate on that particular route with that party. Right, Tanisha? The contract is not with a single party. For example, this bus company has made a contract with Mr. A. And Mr. A, let's say Mr. A, or I can say that Mr. A is a municipality, is an East Delhi municipality. So this East Delhi municipality says that you have to operate on 2 routes, east to south, east to north. These 2 routes are profit making. Then the South Delhi municipality says that you have to operate on this particular route, south to north. This is loss making. West Delhi municipality again saying west to north. This is profit making, right? So friends, if the contract is with the different parties, you have to see the genesis, you have to see the substance. In case of that South municipality, when it is in the loss, So their contract was to operate only on that route, right? That single route is a single contract. Okay. So in that case, you can assess the individual asset recoverable value, right? Because the losing or winning of that single route does not impact the other routes, right? In that case, it is not a CGU. In that case, it is a individual asset. It is an individual asset, right, Tanisha? So the conclusion is that the variability of the form of contract determines the type of asset, individual or CGU. Is it, Tanisha? Yes. You have to see whether this contract is a single contract or this contract is a multiple contract. Means the performance on part of the contract is impacting the overall contract or not. That you need to see. If in the same example of this 7 routes, if the municipality will say that whatever route will be in the losses, you can avoid that. Avoid that route means you can just leave that route. In that case, it means that particular route is not impacting the operation on these 6 routes. In that case, it is not a group of asset, it is an individual asset concept, right? From the perspective of assessment of recoverable value, friends, why I picked this question, illustration number 16? Because on the face of it, on the form of it, you are looking that there are separate cash flow, there are a separate asset. Even bus fair value is separate, right? You can sell the bus separately. But on the substance, it is not a single asset, it is a group of asset concept. So friends, this group of asset concept is only from the perspective of assessment of impairment losses, right? From the assessment of impairment losses. Is that clear? Is that clear, Tanisha? What is the answer which is given in the question? Because the entity does not have the option to cut down any bus route, the lowest level, the smallest level of identifiable cash inflows that are largely independent from the other assets or group of assets is the cash flow generated by 7 routes together. The CGU for each route is the bus company as a whole, right? So single route is not a CGU. The entire bus company is a cash generating unit, right? I hope you guys are well understood about this concept. You guys have well understood. Friends, what factors you need to consider in identification of cash generating unit? Theoretical concept. So ability to generate independent cash inflow from other assets. Okay. First of all, if you are saying my four assets are my cash generating unit in a bigger plant. For example, if you guys have went to the some manufacturing unit like Jindal Steel and Power Limited, right? In Jindal Steel and Power Limited, they have multiple plant inside. Like they have a plate mill, they have a sinter plant, they have a furnace, right? They have a power plant. So when you go to Jindal Steel and Power, there is a one plant, but in that one plant, inside there is a multiple plant, right? Multiple plant means those bigger group of machineries, those bigger group of plant and machineries are playing a different role. Whatever output they are producing, right? It is sellable in the market, right? It is sellable in the market. Might be the case that output is consumed internally as a raw material for the other plant, but this output is independently sellable in the market, right? So those plants inside are the separate cash generating unit. So friends, first of all, you need to look at it should be able to generate independent cash flows. Number two, you are also required to see how management makes a decision about the continuing or disposing of asset or operation, right? For example, the management is saying that my product line is my cash generating unit. Management is saying my business is my cash generating unit, right? For example, some tower companies, some telecom tower companies say that. So normally how this telecom tower company operates, the telecom tower company operates by state wise. They call it as a circle, telecom circle. For example, there are 22 telecom circle in India. Okay. So these telecom companies operates by circle wise. Let's say Maharashtra and Goa is a circle. Maharashtra and Goa is one circle, right? So For this telecom tower company has, let's say, 20,000 towers in Maharashtra and Goa. MNG, they call it as a MNG, Maharashtra and Goa. Delhi is one circle. Okay. So they say that my circle is my cash generating unit, because they evaluate their business by the circles. They have a separate circle P&L, profit and loss. They are assessing the profitability of each circle. They have a separate circle offices. So they have an office in each circle. They have a CEO, chief executive officer. They have a CFO for every circle. It means this company business model is bifurcated into the business locations, into the business, different businesses or individual locations, right? So for this telecom tower company, this entire circle, right, 22 states, 22 telecom circle is a cash generating unit. Single circle is a single cash generating unit, which have around thousands of tower sites. For example, other company, let's say Hindustan Unilever Limited, they have 10 manufacturing plants. Okay. So they call it that every manufacturing plant is a cash generating unit. Every manufacturing plant is a cash generating unit, right? So they go by the individual locations, or they go by the businesses, right? The company which are into the 5 business, like real estate business, electronic business, okay, and FMCG business, like your IT business. So they say that they used to take all the decisions business wise. Business wise means they see the performance profitability by business wise, right? So in that case, they call that every business is my single cash generating unit. So you need to also consider that how management makes a decision about continuing or disposing of assets or operation, right? Some management takes a decision on business wise, some individual location, regional area, geography, product line. So that is also one of the factor that how you will determine the cash generating unit, right, friends? But whatever cash generating unit you identify, it has to be consistent from one period to another. You cannot say that today my entire plant is a cash generating unit. Tomorrow you will say that no, 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 no. In my entire plant, there are patches of group of machineries, right? So now my entire plant is not cash generating unit. My 5 group of machineries installed in this plant is the 5 cash generating unit, right? You cannot say that. Okay. You cannot say that. Let's discuss this case study. A mining entity owns a private railway to support its mining activity. You must have heard about this. Mining entities have some railway track outside their mines, and some coaches are there which carry the extraction of these mineral ores. They dump into the coaches and they transport from that coaches. The private railway could be sold only for the scrap value, and it does not generate cash inflow that are largely independent of the cash inflows from the other assets of the mine, right? And the objective of this coaches, right, this private railway, is only to support the mining activity. Whatever ores, whatever extraction has been done, so they have to transport to a site, okay, where this has to be dumped, or to the plant. So this private railway does not have any role. I mean to say, any role in terms of earning the money, means they cannot generating the cash flow independently, right? They cannot carry passengers. Okay. They are dedicated for this mine. They are dedicated for taking this extraction and dumping to a site, right? So this railway, this private rail track is only dedicated to the mining activities. Now the question arises, so tomorrow, if the company has to sell this private railway, so this private railway has been sold like a scrap only. Okay. Should the entity determine the recoverable amount for the private railway or for the mining business as a whole? So the question arises whether this private railway is a single individual asset, or if the company has to do the impairment testing, company has to determine the recoverable amount, whether this company has to determine the recoverable amount for this private railway as an individual asset, or for the mining business as a whole, which includes the other mining assets, and private railway as a one business. What is your recommendation? What is your view? What is your recommendation, guys? What is your views? What is your recommendation, friends? What one should do? Rahul is saying the entire mining business is a cash generating unit. Okay. What about others? What about others? Tanisha is saying it has to recognize it as a single unit. You are right. It is not possible to estimate the recoverable amount of the private railway because its value in use cannot be determined and is probably different from scrap value, right? So the scrap value is not value in use, right? Although this private railway plays an important role, right? And that is why this private railway has a value in the business. But the point is value in use cannot be determined. The terminal cash flow, we know that terminal cash flow is a scrap, but the cash flow from the continuing use of the asset cannot be determined. Therefore, the entity estimate the recoverable amount of the cash generating unit to which the private railway belongs. That is a mining entity as a whole. That is a mining entity as a whole, right? Is that clear, friends? Is that clear? Clear or clear? Clear or clear? Clear in mind or clear from mind? Very good. Thank you. Let's move on to the next concept. Goodwill. Allocation to CGU. Friends, first of all, goodwill. In Ind AS 38, you have understood so far that internally generated goodwill is not allowed to be recognized. You all are clear on that? Internally generated goodwill is prohibited. Internally generated goodwill is prohibited to recognize. Now, how this goodwill will come into the picture? The goodwill will come into the picture when the company acquire a business. When the company acquired a group of asset, which is a business, right? And let's say A Limited has acquired B Limited, or A Limited has acquired a business segment of a B Limited. And for that, A Limited is paying a premium. And what is that premium? That premium is a goodwill. So now the question arises, let's say from A Limited is acquiring the business of B Limited, and with that, A Limited is paying a premium. And why A Limited is acquiring a B Limited? Because B Limited has a formula, which will provide a synergy to the existing business of A Limited as well, right? So first of all, whatever business A Limited is acquiring, right, that have some segment, that have some cash generating unit, standard says that goodwill acquired in business combination, has to be allocated to the cash generating unit, which is expected to have some benefit from this acquisition, right? As I told you that this formula will help, is this provide synergy, this provide benefit to the existing cash generating unit of this company as well. So it says that whatever premium I am paying, that goodwill needs to be allocated to the cash generating unit, which is expected to have the benefit from such acquisition, right? From such combination. Is that clear? So this goodwill needs to be allocated to the cash generating unit. Okay. And this goodwill needs to be allocated to the cash generating unit, right? On the lowest level. Lowest level means the level at which the entity is monitoring its performance. It means that should be the segment. So such allocated units should not be larger than an operating segment as per Ind AS 108, right? So it is not like, for example, in a one business, the company is saying I have three segment. For example, in one business, the company has three plant, and company is saying this three plant is my three segment. So in that case, company cannot allocate this goodwill to the entire business. Company should allocate the goodwill to these three plants, right? These three plants. Sir, how this can be allocated? Probably on the basis of their values, net assets value, right? For let's say the plant one net asset value is 100 crores, plant B net asset value is 200 crores, plant C net asset value is 300 crores, and the company has paid a goodwill of 50 crores for acquiring the new business. So this 50 crore has to be allocated in the ratio of 100 is to 200 is to 300 in the plant A, B, and C, right? This is what it is written in the question, right, friends? So have you understood the concept of cash generating unit so far? Have you understood the concept of goodwill, that goodwill needs to be allocated to all the cash generating unit, which is expected to have a benefit for which you have paid a goodwill amount? Is that clear, friends? Is it clear? Okay. Friends, now a very important concept. Sir, what is the frequency and timing of impairment assessment of cash generating unit? You remember, I told you that impairment testing of an individual asset is required only when there is an indicator of impairment. You remember that? In the initial part of the session, I told you impairment testing is required for an individual asset only when there is an indicator of impairment, right? Then I told you for three assets like intangible asset having indefinite life, not yet available for use, and goodwill arising in business combination. For these three assets, impairment testing is required to be done at least once in a year on a mandatory basis. This is what I told you, right? Now let's discuss the frequency and timing of impairment testing, impairment assessment of cash generating unit. Says that cash generating unit with goodwill. So there is a group of assets, there is a cash generating unit, and in that cash generating unit, goodwill is there, or indefinite life intangible is there, or intangible asset not yet available for use is also there. Right? In that case, standard says that if there is no indication of impairment, please see the left side. Please see the left side, right side first. The standard says that if there is no indication of impairment, I told you for three assets, intangible assets, indefinite life, not yet available for use, and goodwill. For these three assets, you are not required to see the whether indicator are there or not there. You have to do the mandatory impairment testing once in a year. So test for impairment annually. So any cash generating unit which is having either goodwill, either intangible asset, indefinite life, or not yet available for use, that group of asset, that cash generating unit, impairment testing is required to be done on annual basis, right? When there is no indication of impairment, the impairment testing is required to be done on an annual basis. If there is an indication of impairment, then what happens? For example, there is a listed company. Listed company has a cash generating unit, and that cash generating unit is having a goodwill. So impairment testing is required once in a year, mandatory. But there are impairment indicator in every quarter. In that case, that entity is required to test for impairment on a more frequent basis whenever there is an indicator of impairment. Sir, if no indicator of impairment is there throughout the year, in that case, at least once in a year is required. But sir, if there are indicator of impairment frequently, then frequent impairment testing is required. Any doubt in this? Any doubt in understanding this thing? Any doubt? Clear? Clear? What happens if the cash generating unit does not have such assets? Asset or cash generating unit, this cash generating unit does not have goodwill, intangible asset with indefinite life, or not yet available for use. This group of asset only having 3 pp, 4 pp, No such item are there. In that case, if no indication of impairment, nothing is required. If there is an indication of impairment, then only impairment is required, right? Understood? So what is the difference in the earlier slide and this slide? In the earlier slide and this slide, the difference is, in this case, when these exception assets are not there, in this kind of CGU, if there is no indication of impairment, no impairment testing is required. But if there is an indication of impairment, then only impairment testing is required. Sir, if indicators are more frequent, then more frequent impairment testing is required. So left side is same. Left side is same in both the cases, but right side is different. In case of the earlier slide, in the right side, even though no indication of impairment was there, at least once in a year impairment testing is required. In this case, if no indication is there, no impairment testing is there. All clear? All clear, friend? Same concept. You remember I told you, when you are doing an impairment testing of a cash generating unit, it has to be consistent. For example, if you are assessing the impairment of a cash generating unit where these exception assets are there, and you are performing the impairment testing in second quarter, in the next year again you need to perform in the second quarter. It has to be consistent and it has to be performed at the same time every year, right? Sir, if I have 5 CGU, for example, if I have 5 group of asset, I have 5 plant across India, and every plant, right, every plant is supposed to have a impairment testing once in a year. Why? Because every plant has a goodwill allocated. Sir, I am assessing the impairment. I am assessing the recoverable value or calculating the recoverable value, doing the impairment testing of one plant in quarter one, another again quarter two, third quarter three, and in quarter four the remaining 2 plants. Sir, can I do so? Answer is yes. But again, you have to be consistent and you have to ensure that the time frame should be same every year for these plants, right? Sir, this assessing the recoverable value of a cash generating unit is again a time and cost compulsive exercise, right? Sir, let's say if I have done the impairment testing last year, okay, and when I calculated recoverable value, my recoverable value is way more than my carrying value. It is significantly higher than my carrying value. Can I use that calculation? Answer is yes. Standard says that if in the previous assessment the recoverable value is much more than the carrying value, it is significantly higher than the carrying value with a substantial margin, and there is no business model or composition of cash generating unit has been changed, still the structure, composition, business model is same in this year also, you can use that last year calculation as well, right? Friend, this was the concept of cash generating unit and the impairment testing of cash generating unit. I will discuss the allocation of impairment loss on the cash generating unit, right? But before that, let's discuss the concept of corporate assets. Before starting the concept of the corporate asset, I would like to understand if you have any question so far. If you don't have any questions so far, then let's have a break for. So Tanisha has a question. Sir, is it for the listed company also? Then it can choose not to test for impairment. Yes, Tanisha. The concept is same for listed and unlisted companies both, right? Concept is same. The concept is if the listed company does not have any indicator of impairment, it is not required to assess the impairment, right? If there is an indicator of impairment, impairment testing is required. Okay. So friends, it's 8:24 now. Let's have a break for 10 minutes and we will start at 8:34. Okay. We'll start at 8:34. Friends, let's discuss the concept of corporate asset. What is meant by corporate assets? Since being a CA final students, you guys have went to so many clients on the audits, and you have seen that, one, there is a revenue producing part, the another one which is administrative part of the asset. For example, a company which has a factory building. So factory building is a revenue producing asset. Okay, because in the factory building the output is getting produced, and the company is able to get the money by selling those products, by selling those goods and services. But there is again another building which is just acting like a head office, headquarter, right? Where where the output is not produced, which is not a profit center, which is more like a cost center, which is more like a administrative department, right? So again, if I compare my office building with factory building, or my head office building with a factory building, the basic difference is my factory building is important to run my business. It is important to win the bread and butter. But my office building is mandatory. It is also required. It is also important to ensure that the compliances should be proper, the records should be maintained, the accounts should be maintained, the audit should happen, right? So the business performance can be evaluated. So all these things, which is again important to run the business, is happened in my office building, right? The only thing is the office building is not generating cash flow. However, the factory building is generating cash flow, right? Now the question arises, sir, in these cases where the corporate assets are there which are not generating independent cash flow, then how to do the impairment testing of this corporate asset as well? How to compute the recoverable amount of the corporate asset? So standard says that the recoverable amount of the corporate asset should be should be determined for the cash generating unit to which this corporate asset belong, and compared with the carrying amount of that CGU. Sir, what does it mean? Let's say the company has 5 factory building. To manage this 5 factory building, the company has 1 office building, right? So this 1 office building needs to be clubbed with this factory building, this 5 factory building, and this will become a CGU. This will become a CGU, right? And and this corporate asset belong to this CGU, right? And then the carrying amount of this CGU needs to be compared to check the impairment loss on this corporate asset or not, right? Sir, not able to understand very much on that. Have you understood the concept of corporate asset? Corporate asset are not revenue generating asset. You cannot compute the cash flows of the corporate asset, and hence the recoverable amount of the cash corporate asset cannot be determined. Hence, standard says that the corporate asset needs to be clubbed with the cash generating unit, or those assets or those cash generating unit to which this corporate asset belongs, right? And after that, you need to compare and you need to compute the impairment loss on these corporate assets. Sir, how will I do that? So I will explain this part with the help of an example, right? With the help of an example. Example of corporate asset. Just a minute. Let me take an example of a corporate asset. Yes, this one. Case study, allocation of impairment loss on a corporate asset. ABC Limited has 3 cash generating unit A, B, and C. The carrying amount of which, as on 31st March 2001, are as follows. Right. There are 3 cash generating unit A, B, and C. The carrying amount is given 500, 750 crores, 1100 crores. The useful life of this A, B, and C cash generating unit are also given. Probably these could be your factory buildings. ABC Limited also has 2 corporate assets having a remaining useful life of 20 years, right? So this ABC Limited has 2 corporate asset also, corporate asset X and Y. The carrying value of this corporate asset is 600 crores and 200 crores. The carrying amount of X can be allocated on a reasonable basis, that is pro rata basis, to the individual cash generating unit. It says that this X is related to all these ABC cash generating unit, and it says that the carrying amount of X can be allocated on a reasonable basis to the individual cash generating unit. It says that the carrying amount of Y cannot be allocated on a reasonable basis to the individual cash generating unit. This question is saying that X can be allocated, Y cannot be allocated. Recoverable amount is also given. The recoverable amount of ABC is given, and the recoverable amount of this entire company is also given, right? This recoverable amount of the entire company is also given. Calculate the impairment loss, if any, and ignore decimals, right? Friends, I will explain this thing with the help of Excel file, and there I will give you all the steps, and accordingly we will solve this case study, right? Is that clear? Accordingly we will solve this case study of this entire corporate asset allocation. Just follow me consciously and follow me carefully. I hope my Excel file is visible to all of you. I hope my Excel file is visible. Is that visible? My Excel file is visible to all of you? Very good. So I am discussing the case study on corporate asset. This is illustration number 8 of ICAI study material. Illustration number 8 of ICAI study material. Allocation of corporate asset and impairment. Right? Allocation of corporate asset and impairment. Now, what is given in the question? So before that, I will just tell you the steps. Step number 1. Allocate corporate asset in the ratio of cash generating unit. Allocate corporate asset in the ratio of cash generating unit. Step number 1. Allocate corporate asset in the ratio of CGU. Step number 2. Calculate carrying value of the CGU after including corporate asset value. Calculate carrying value of the CGU after including corporate asset value. Step number 3. Compare the total carrying value. Compare the total carrying value. Which total carrying value? Carrying value in step number 2. With recoverable amount. With recoverable amount. Right. Step number 4. Calculate impairment loss, if any. Step number 5. Allocate impairment loss in CGU and corporate asset in the ratio of their carrying value. Sir, not understood. No problem. Now let's talk to the solution of this particular case study, right? And in this question, the value of corporate asset is given. In this question, the value of corporate asset is given. It is given or not given? In this question, the value of the corporate asset is given. Just a minute. Just give me a minute. Just give me a minute, friend. There is a technical problem in my Excel. Just give me a moment. This is not a right question. Let me open the study material. So I'm opening the study material, and from there I'll discuss this thing. Just a minute. So to explain the concept, I'm just opening the study material. Yes. Do let me know if the study material is visible. Yes. Is it visible now? Because I need to cover this illustration first to make you guys understand the steps, right? How to compute the carrying value, recoverable value, and impairment loss on in case of a impairment of corporate asset, right? This company Earth Infra Limited has two cash generating unit A and B. This company has two cash generating unit A and B. There is no goodwill within the units. Okay, there is no goodwill within the units carrying values. The carrying value of the CGU are CGU A for 20 million, CGU B for 30 million. So in this case, the carrying value of the CGU A and B is given. Okay. And the company has an office building which it is using as an office headquarter and has not been included in the above values and can be allocated to the units on the basis of their carrying values, right? The office building has a carrying value of rupees 10 million. The office building has a carrying value of rupees 10 million. The recoverable amounts are based on value in use of 18 million for CGU A and 38 million for CGU B. Now, what is given in this question? First of all, let's understand what is given in this question. In this question, two cash generating unit are given, A and B, right? And the carrying value of those two CGU are given, which is 20 million and 30 million. The company has an office building, which is a corporate asset, right? And the value of this, the carrying value of this corporate asset is 10 million, right? Which is not included in this 20 and 30. It says that this 10 million can be allocated. This office building is supporting A and B. So this 10 million can be allocated to A and B, CGU A and CGU B in the ratio of their carrying value, which is 20 is to 30. And in this question, the recoverable value, which is based on value in use, is also given for CGU A and CGU B. What is the requirement? Determine whether the carrying value of CGU A and B are impaired. The requirement is whether cash generating unit A and B should be impaired or not, right? Considering there is a corporate asset also. So now how to solve this question? So let me explain how to solve this question. Friends, in this case, first of all, allocate corporate asset in the ratio of CGU. Allocate corporate asset in the ratio of CGU. Now, what is the value of my corporate asset? It is 10 million. Value of my corporate asset is 10 million, right? This is the value of the corporate asset. It is 10 million. Corporate asset. How much? 10 million. Friend, what is my value, carrying value of CGU and CGUB? My carrying value of CGU A and CGU B, carrying value of CGU A and CGU B. My carrying value of CGU A and CGU B. How much is the carrying value of CGU and CGUB? 20 million and 30 million, right? This is given in the question, 20 million and 30 million. What is my step number one? What is my step number one? Allocate corporate asset in the ratio of carrying value. But let me write whatever is given in the question. Let me write in the left side. Recoverable value is also given in the question. Recoverable value is given in the question. Recoverable value for CGU A and CGUB. How much? is the recoverable value. 18 million and 38 million. 18 million and 38 million. This is my recoverable value. This is what it is given in the question, right? Now we will perform step by step. We will perform all the steps. Okay, we'll perform all the steps. What is my step number one? What is my step number one? The carrying value is given. In this question, the carrying value is given, right? The carrying value of CGU A is given, which is 20 million, and carrying value of CGU B is 30 million. What is the total? What is the total? The total is 50 million. Step number one. What is my step number one? What is my step number one? Allocate the corporate asset in the ratio of cash generating unit. Corporate asset allocation. Corporate asset allocation. How much is my corporate asset? It is 10 million. It is 10 million. 10 million needs to be allocated in the ratio of 2:3, right? So can I write 10 multiply by 20 divide by 50? Can I say divide by 50? 4. 10 multiply by 30 divide by 50 divide by 50. 6. So this 4 and 6 will be my corporate asset allocation in the ratio of the carrying value of CGU. What was my step number one? Allocate corporate asset in the ratio of CGU. What is my step number two? Calculate carrying value of CGU after including corporate asset value. So what is my step two? Carrying value of CGU after corporate asset, right? After corporate asset. This is my carrying value of CGU after corporate asset. How much is the carrying value of CGU? 20 plus 4, 24, 36, and total is 60, right? This is my step number two. This is my step number two. Is that clear to everyone? Step one, step two is clear to everyone? Yeah, it is clear to everyone. Okay. What is my step number three? Compare the total carrying value, which is step number two, with the recoverable value. What is my recoverable value given in the question? It is given in the question, step number three. Your recoverable amount is given, step number three. What is the step number three? Recoverable value. The recoverable value is given in the question. For CGU A it is 18 million. For CGU B it is 38 million. And the total is 18 plus 38. What is my step number four? Now I have also computed recoverable value. What is my step number four? What is my step number four? What is my step number four? क्या है मेरा step number four? Calculate impairment loss, if any, as simple as that. Calculate impairment loss. Impairment loss. The carrying value in step number two, which is after inclusion of corporate asset, the carrying value is 24 million. But the recoverable value is only 16 million for this cash generating unit. So what is my impairment loss? My impairment loss is 6 million. In CGUB, the carrying value is 36 million, but the recoverable value is 38 million. Do I have any impairment loss? No impairment. In CGUB, no impairment will be there. No impairment. What is my step number five? What is my step number 5? Now I know the impairment loss. I know the revise. In the step number 1, I have allocated the value of corporate asset into the carrying value. In step number 2, I got the revised carrying values. In step number 3, I know the recoverable value. In step number 4, I have computed the impairment loss. Now what to do in step number 5? Allocate the impairment loss. Allocation of impairment loss. Allocation of impairment loss. How much is the impairment loss? The impairment loss of CGUA of 6 million is only there. So I need to allocate the impairment loss. Now, how can I allocate the impairment loss? I need to allocate the impairment loss in the ratio of what? In the ratio of carrying value of the CGU without corporate asset and the corporate asset Simple, right? What is my carrying value? What is my carrying value of the CGUA? 20 million. What is my carrying value of corporate asset which is allocated? 4 million in this CGU. So I need to allocate this impairment loss in CGUA except excluding corporate asset and corporate asset. How will I allocate this impairment loss of 6 million? I need to allocate this impairment loss of 6 million. 6 multiply by 20 divide by 24. 6 multiply by 4 divide by 24. In the ratio of carrying value, how I have allocated impairment loss? I have allocated impairment loss in the ratio of carrying values of CGU excluding corporate asset and corporate and only corporate asset. Right? This is how this corporate asset needs to become part of CGU, and this is how this impairment has to be done in case of these CGU and the corporate asset, right? So you can see that this corporate asset, the impairment loss allocated to the corporate asset is 1 million. It is 1 million, right? So now what is the revised carrying value? What is the revised carrying value after impairment loss? See, what is my earlier carrying values? My earlier carrying values. What is my earlier carrying values? CGU A, CGU B and corporate asset. CGU A and B and corporate asset. My earlier carrying values 20 million, 30 million, and for corporate asset it is 10 million, right? 10 million. This is my earlier carrying value. Now my revised carrying value. The revised carrying value. What is my revised carrying value? What is my revised carrying value? 20 million was the earlier carrying value, but impairment loss of 5 million has to be charged on this. 30 million, there is no impairment on CGUB. Corporate asset 10 million minus 1 million impairment has been charged, 9 million. So this is the revised carrying value. The difference between the earlier carrying value and the revised carrying value is 6 million, which is nothing, it's an impairment. Friends, have you understood this concept of corporate asset, allocation of corporate asset, and then assessment of impairment loss on corporate asset? Have you understood this concept? Yeah. Guys, let me know if you have any problem. I will again explain the entire concept. Guys, do let me know if you have any problem or if you have not understood any step. I will again explain the entire step of this allocation of corporate asset and assessment of impairment. Guys, do let me know. Tanisha, is that clear? Neha, Rahul is saying, sir, it is absolutely clear. You understood why the concept of corporate asset is given separately? The concept of corporate asset is given separately. Why? Because the corporate asset does not generate any cash flow. These corporate assets are only supporting the business to generate the cash flow. These are not directly generating the cash flow, and that is why the company is allocating the carrying value of the corporate asset into the other cash generating unit. But in which ratio? The ratio is in the ratio of the carrying value of the cash generating units, right? Now the company has a revised carrying value. The step number one is to allocate the value of the corporate asset into the relevant cash generating unit in the ratio of their carrying value. So you have allocated. Now you have a revised carrying value including corporate asset, right? Step number two is complete. Step number three, in the question it will be given the recoverable value of the cash generating unit will be given. Now you have to check the recoverable value, right? When you got the recoverable value, when you have the carrying value, now in the step number 4 you have to assess whether impairment loss will be there or it will not be there. Like in CGU B, this impairment loss was not there, but in CGU A the impairment loss was there. So you need to assess the impairment loss. Once you have assessed the impairment loss, now it's a time to allocate this impairment loss. How to allocate? You remember the first step, when you have the carrying value of that CGU without corporate asset, then you have a carrying value of the corporate asset which is allocated to this CGU. So this impairment loss has to be allocated in the ratio of the carrying value of CGU and the carrying value of the corporate asset allocated to that CGU, right? This is how you will get the impairment loss on that corporate asset. And then when you compute the revised carrying value, like in this question, you have found out that the revised carrying value has been reduced from 10 million to 9 million. Why? Because 1 million has also been allocated to the corporate asset. In addition to in addition of 5 million to the cash generating unit, right? All okay, friends? All okay? Okay. Now, friends, I'll discuss one of the important part, which is allocation of impairment loss to the corporate, allocation of impairment loss to the cash generating unit, right? How to allocate the impairment loss to the cash generating unit. For explaining this concept, I will use the Excel file throughout. Please do let me know if my Excel file is visible to all of you. Please do let me know. Is it visible? Okay. Let me My Excel file is visible, yes. So let's go to, now I'll discuss the allocation of impairment loss to cash generating unit, right? And I'll take 2 3 examples, and with those example I will explain this concept. With those example I'll explain this concept. Okay. We are discussing allocation of impairment loss on cash generating unit. How to allocate impairment loss on cash generating unit. Now, first of all, case 1. I'm giving you some cases, and with that I'll make you understand that how to do that. So in the CGU, some assets are there. This is a CGU. Some assets are there in the CGU. The name of the asset are building, Goodwill. So Goodwill is there. Building is there. Building, machinery, software. These 4 assets are there in this CGU. And the carrying value is also there. The carrying value of the goodwill is 20 crores, let's say. The carrying value of building is, let's say, 30 crores. The carrying value of machinery and software, let's take 20 crores. Let's take 20 crores, right? So what is the total carrying value? The total carrying value comes out at how much? How much? 90 crores, right? The total carrying value is 90 crores. This is a cash generating unit. In the cash generating unit, 4 assets are there: goodwill, building, machinery, software. Now what happens? Let me give you more information here. The recoverable value of the CGU is 60 million. The recoverable value of the CGU is 60 million. Okay, it is given in the question. Compute the impairment loss on CGU, and you are required to show how to allocate the impairment loss on multiple assets of CGU and their revised carrying value post impairment. It is given in the question. The recoverable value of CGU is 60 million. Compute impairment loss on CGU and show how to allocate the impairment loss on multiple assets of CGU and their revised carrying value post impairment. This is the requirement of the question. This is the requirement of the question. Okay. So friends, what is given in this case? In this case, carrying value is given, recoverable value is given. What is my impairment loss? Carrying value is, how much is my carrying value? My carrying value is 90 million. My recoverable value is 60 million. So what is my impairment loss? My impairment loss is 30 million. My impairment loss is 30 million. Is 30 million. Okay. This impairment loss is 30 million. Any doubt so far? Very simple question. There are 4 assets in the cash generating unit. Carrying value, the total is 90 million. And this is the smallest group of assets, right? Which is not generating the cash flow independently. Hence, we have clubbed the asset. Okay. And when we assess the recoverable value of this entire group of assets, we find out it is only 60 million. So there is an impairment loss on the group of asset, and the impairment loss is nothing. It's a impairment loss is 30 million. Now the question comes, how to allocate the impairment loss on the individual asset? How to allocate the impairment loss on the individual asset? Friend, standard says that in case there is an impairment loss on CGU, what you are required to do? First, adjust the goodwill to the extent of the impairment loss. First, adjust the goodwill to the extent of impairment loss. So now, allocation of impairment loss. Now there is an allocation of impairment loss. How to allocate the impairment loss? Standard is the first you need to allocate the complete impairment loss to the goodwill. Complete impairment loss to the goodwill, right? 20. Okay. So what is your revised carrying value? What will be your revised carrying value? Your revised carrying value will become how much? For this goodwill, your revised carrying value will become 0 because you have adjusted. Now, friends, the point is you have a 30 million of impairment loss and you have allocated only 20 million. You have 30 million of impairment loss, but you have allocated only 20 million. So where the 10 million will go? Where the 10 million impairment loss will go? Where the 10 million impairment loss will go? Tanisha, Viraj, tell me, where the 10 million impairment loss will go? Standard says that after adjusting the goodwill to the extent of impairment loss, adjust the other asset in proportion to their carrying value. Then adjust the other asset in proportion to their carrying values. It means the remaining 10 million needs to be allocated to this building, machinery and software. in the ratio of their carrying value. 3:2:2 means minus 10 multiply by 30 divide by what is the total? 30, 20, 50, 20, 70. The total is 70, right? Clear? Means minus 10 multiply by 20 divide by 70 minus 20 multiply by minus 10 multiply by 20 divide by 70. This is how you have allocated your impairment loss. You have allocated your impairment loss on the on your CGU, on the remaining asset of your CGU. This is how you have allocated your impairment loss on the remaining asset of your CGU, right? I hope there is no any problem in this. I hope it is quite simple. So what we have done first, if there is an impairment loss on the CGU, we have allocated the impairment loss on the multiple assets of CGU. How we have allocated? If there was a goodwill, first we have taken a full hit on the goodwill, right? Still, if there is some additional impairment loss, we have allocated the impairment loss in the proportion of the carrying value of the remaining assets, right? Very simple. Any doubt here? If there is no doubt, then I'll make this case study more complex now. I'll make this case study more complex now. If you don't have any doubt, so let me give you a case too. And friends, if you have understood the concept, all the problem will be solved with the help of this concept only, right? And that is why I'm giving a lot of cases. Case 2. What is my case 2? So Viraj, it is given in the standard that why to take first hit on goodwill. It is as per the standard. Standard says that. Why? Because if the value of your asset is declining, it means there is no goodwill. What is the concept of goodwill? When you are acquiring business, you are paying premium. Premium means more than the value of the asset you are paying. Why you are paying? Because those assets have some synergies. And you are thinking that the value of this business will go up. But now the value of the assets are going down. So what does it mean? It means there is no goodwill. So standard says that, even your accounting standard, Ind AS, IFRS, all says that if there is a decline in the value of the group of asset, first of all, you have to adjust the decline to the goodwill, first of all. Second, the remaining impairment loss needs to be allocated to the ratio of the remaining asset. So Viraj, what is the remaining carrying value? What is the remaining impairment loss? This remaining impairment loss is 30 million, na? The total impairment loss is 30 million. You have adjusted 20 million to your goodwill. Now the balance impairment loss is 10 million. The balance impairment loss is 10 million. So this building, machinery and software, what is the ratio? What is the ratio of building, machinery and software? The ratio is 3:2:2, na? What is the ratio of carrying value of the building, machinery and software? 3:2:2. How much I need to allocate? So 3:2:2. What is the total? Total is 7. 3, 2, 5, 2, 7. So simple, I have allocated 10,000 in the ratio of 3:2:2. Please allocate 10,000 in the ratio of 3:2:2. You will get 4, 3 and 3. Simple. Yeah. Viraj, have you understood now? It is the provision of the standard. It is the rule which is given. If there is an impairment loss on the group of asset, first of all, you have to take the hit to the goodwill. If still remaining impairment loss is there, then you need to allocate the remaining impairment loss in the proportion of the carrying value of the remaining asset, in the ratio of carrying value of remaining asset. Simple ratio. 10 को मैंने क्या किया? 3:2:2 में split कर दिया, बस. This is what we have started, understanding since our class 5 or class 6. Allocating into the ratios. Simple. This is how I have computed my revised carrying value after allocating the impairment loss. Now I am making this case study more complex. Case study number 2. Case number 2. What is that? Again, allocation of impairment loss on CGU, right? Same. Your CGU is goodwill, building, machinery, software, same. I'll just copy from here. This is your cash generating unit. These are the assets in your cash generating unit, right? And these are the carrying value of this asset, right? Now some information is given. The recoverable value of the cash generating unit is 60 million. Same information. Calculate impairment loss on CGU and show how to allocate the impairment loss on multiple assets of CGU and then revise carrying value post impairment. I am just copying pasting this line. I am just copy pasting these two lines. Okay. Understood. Sir, this entire thing is same what you have covered in case study number 1. I am putting one more line here and I am putting that the recoverable value of the building is 32 million. Recoverable value of the building is 32 million. Right? The recoverable value of building is 32 million. This is the additional information which is given in this question. Case 2 in addition to case 1. Right? Now you need to allocate the impairment loss. You need to allocate the impairment loss. You need to allocate the impairment loss. Right? What is your impairment loss? Impairment loss is same. Carrying value 90 million, recoverable value 60 million, and impairment loss is 30 million. Right? So first of all, what is the provision? What is the provision? In case there is an impairment loss on CGU, first adjust the goodwill to the extent of impairment loss, then adjust the other assets in the pro rata basis. This is the provision. So first of all, I need to show my goodwill. I need to charge the impairment loss to the extent of goodwill. Right? First of all, I have done that. Okay, it is 0. Now still I'm left with 10 million of impairment loss. Still I'm left with 10 million of impairment loss. How to allocate this 10 million of impairment loss? You told us that please allocate this 10 million in the ratio of the remaining asset 3:2:2. Right? Friends, I have given one additional information in this question and I have said that the recoverable value of building is 32 million. This is what I have given additional in this question. Viraj, it is applicable for all situations. Friends, please tell me what is the treatment of 10 million considering one additional information is given in the examination question. It says that the recoverable value of the good building is 32 million. Tell me what to do with this. Friend, standard says that in a group of asset, in a cash generating unit, in a group of asset, if a individual asset recoverable value can be determined, if an individual asset recoverable value can be determined, in that case, the allocated impairment loss should not make the value of that intangible asset less than the value of its individual recoverable value. Sir, what does it mean? In this case, the carrying value of the building is 30 million. Building की carrying value कितनी है? 30 million है. What is the recoverable value of this building? 32 million. So going individually, ये जो recoverable value है, वो 32 मिलियन है बिल्डिंग की, और बिल्डिंग की कैरिंग वैल्यू 30 मिलियन है। इसका मतलब है बिल्डिंग शुड नॉट बी impaired, because you know the individual recoverable value of this group of asset, one of the asset in the group of asset, you know that। इसका ये मतलब है कि अगर किसी एसेट का इंडिविजुअल रिकवरेबल वैल्यू पता है तो आपका इंपेयरमेंट लॉस एलोकेशन उससे ज्यादा नहीं होगा। In this case, the recoverable value is higher than the carrying value. It means there is no impairment. It means there is no impairment on this building. It means no impairment on this building. The revised carrying value will be 30 million itself. You right? Remarks. So it says that remarks. Here, what is the remarks? Goodwill written off. Here, the goodwill has written off. In this case, because the recoverable value is more than carrying value, recoverable value is more than carrying value, hence no allocation of impairment loss, right? Because the recoverable value is more than the carrying value, hence no allocation of impairment loss. Sir, still we have 10 million of impairment loss. So this 10 million has to be allocated on the remaining asset on a pro rata basis. Minus 10 multiply by 20 divide by 20 plus 20, 40, right? Simple, 2:2. It has to be allocated in the ratio of 2:2. Simple, right? So this is the value. Impairment loss allocated on pro rata basis. Impairment loss allocated on pro rata basis. Impairment loss allocated on pro rata basis. Yeah. Is that clear, friends? Is that clear, Viraj? Or not clear? Please tell me. What is the concept? First, the concept is adjust goodwill while allocating the impairment loss to the CGU. After that, you have to allocate the impairment loss on the pro rata basis on the remaining asset. But if a particular asset recoverable value is more than the carrying value, on that asset impairment is not going to be allocated. So in that cases, the remaining impairment loss has to be allocated to the remaining assets on a pro rata basis. Is this clear to everyone? Now let me make it more complex. Case number 3. Case 3. Case 3. What is my case 3? Same case study is my case 3. But this is my case 3. Same case study. Okay. I have copy pasted. I have just done one thing. Instead of this recoverable value of building is 32 million, let me write 28 million here. I have only changed the recoverable value of the building is 28 million. So I have only changed the recoverable value of the building. In the case study number 2, it was 32 million. Now I have made it to 28 million. Same case study, right? Cash generating unit, 4 assets, goodwill, building, machinery, software, 90 million, recoverable value 60 million, impairment loss is 30 million. It is very much clear. Now I need to allocate the impairment loss. in this CGU. Goodwill needs to be, first of all, goodwill needs to be adjusted, right? What is my revised carrying value? This is my revised carrying value. I have 10 million. Now I have 10 million to allocate. How to allocate? Tell me how to allocate. Tell me how to allocate. Guys, first of all, you have the impairment loss on the individual asset. You have the impairment loss on the individual asset. When you are saying that the recoverable value of the building is 28 million, for example, अगर मैं इसमें impairment loss allocate करूं, if I will allocate this impairment loss on this asset, for example, it will only comes out to 1 million. Then what is my revised carrying value in this case? 29 million. But that will not be right, because you are aware that the recoverable value of the individual asset is 28 million. तो आप 29 पे क्यों दिखाओगे? Right? All agree with me? Are you guys agree with me or not? मैं कह रहा हूं कि अगर मुझे इस एसेट की रिकवरेबल वैल्यू पता है, which is 28 million, और अगर मैं इस एसेट पे इंपेयरमेंट लॉस एलोकेट करता हूं तो 29 मिलियन आएगा रिवाइज कैरिंग वैल्यू. आई एम जस्ट एज्यूमिंग. दैट विल नॉट रिफ्लेक्ट अ ट्रू पिक्चर. व्हाई? बिकॉज यू आर अवेयर कि मेरी इस एसेट की 28 मिलियन वैल्यू है, बट एलोकेट करने की वजह से 29 मिलियन आता है. दैट इज नॉट राइट. सेकेंड, if you will allocate the impairment loss, let's say impairment loss comes out at 4 million and your revised carrying value become 26 million, but you are aware that my recoverable value is 28 million. Just due to allocation of impairment loss, it become 26. That is also not right. So standard says that if you are aware about the recoverable value of an individual asset, right? So in that case, that individual recoverable value will be the revised recoverable value, right? So in this case, the recoverable value of the building is given at 28 million. It is given 28 million. We will book an impairment loss of how much? We will book an impairment loss of 28 minus 28 minus 30. Only 2 million. Simple, right? Only 2 million impairment loss needs to be booked. Only 2 million impairment loss needs to be booked, right? So the allocation of impairment loss should not be more than its individual impairment loss, right? The allocation of impairment loss, Viraj, if we will allocate in 3:2:2, in that case, in the first question, in the first case, this was 4 million, right? And if you will do this 4 million impairment, the value comes out at 26 million. But here the recoverable value is 28 million. So the allocation of impairment loss should not be more than its individual impairment. Now, how much total I have booked the impairment loss? 28. How much is left? 8 million is left. Out of 30 million, 22 I have already recorded. Now 8 million is left. This 8 million has to be allocated in the ratio of 2:2 in the ratio of the remaining asset. So minus 8 multiply by 20 divide by 40. Minus 8 multiply by 20 divide by 40. Right? What is my... So my revised carrying value is 60 million. So impairment loss allocated in the ratio of 2:2 pro rata. Impairment loss allocated on pro rata basis. I hope you guys have understood this case 1, 2, and 3, and this is how I'll show you case 1, which was very simple. Goodwill strike off, and then remaining asset impairment loss has been allocated on the remaining asset on the pro rata basis. Second, I have given you an example where a particular asset is not going to be impaired because the recoverable value is much more than the carrying value. So in that case, you have allocated the impairment loss on the remaining asset. In the third case, I have given you an example where an individual asset impairment is given. So you have hit the goodwill, you taken that impairment. So like 22 you have already covered. So the remaining impairment has to be allocated to the remaining asset on the pro rata basis. This is the concept of allocation of impairment loss. This is the concept of allocation of impairment loss in case of cash generating unit. Viraj, have you understood now? Viraj, have you understood the difference between case 1, case 2 and case 3? Have you understood this thing? Yeah. So guys, you just need to understood about the concept. Understanding of concept is very important. Understanding of concept is very important, right? Is that clear? Is that clear? Not clear? I hope it is clear to everyone. I am waiting for the answer because this is an important concept and institute will ask the questions from the allocation of impairment loss only. This is an important concept. This is an important concept. Okay, friends. I hope this is clear to all of you. Let's quickly do one of the case study from ICAI study material. I hope this is visible. Illustration number 20 is visible. Is it visible? Yes, Viraj, you are right. It will be 4 is to, it will be 4 and 4. So happy I'm not aware about that when ICAI should release the study material for multidisciplinary case studies. I need to check with ICAI. Yes, let's discuss this illustration number 20. XYZ Limited has a cash generating unit, which is plant A, on 1st April 2001, having a carrying amount of rupees 1000 crores. Plant A was acquired under a business combination and goodwill of 200 crore was allocated to it. So there is a 200 crore of goodwill. It is depreciated on a straight line basis. Plant A has a useful life of 10 years with no residual value. On 31st March 2002, Plant A has a recoverable amount of 600 crore. So on 1st April 2001, the carrying value of the plant was 1000 crore. The goodwill was 200 crores. Plant A has a recoverable amount of 600 crores. Calculate the impairment loss on Plant A. Also prescribe its allocation as per Ind AS 36. In this question, what is the carrying value? In this question, what is the carrying value? What is the carrying value? The carrying value of the plant is 1000 crores. The carrying value of the goodwill is 200 crores. The total value is 1200 crores. Right? I am talking about 1st April 2001. And here in this question, we were talking about 31st March 2002. So there is a depreciation for 1 year. If 1000 crore is the value, 10 year is the life. What is the depreciation? The depreciation is 100 crores. What is the carrying value of plant? 900 crore. Carrying value of goodwill 200 crore. Carrying value of CGU 1100 crores. But friends, the recoverable amount becomes 600 crore only. It means there is an impairment loss of 500 crore. So where this impairment loss will be allocated? 500 crore. This impairment loss is first of all allocated to goodwill, 200 crores. This goodwill will become zero. The 300 crore impairment loss will be allocated to this plant only because there is only one asset other than goodwill. So the carrying value of this plant will be 600 crore. Total value of the CGU was 1100, 500 crore impairment, carrying value is 600 crores, right? So now this plant has to be depreciated over the next 9 years at a value of 600 crores. You have to compute 600 divided by 9. That will be the depreciation every year. Right? Any doubts? Any clarification you need in this question? Any clarification you will require in this question? Any clarification you will require in this question? Is that clear to everyone? Is that clear to everyone? Yeah? All clear? All clear? Very good. So now, friend, we left with the last concept. We left with the last concept, and that last concept is the concept of reversal of impairment loss. We understood the cash generating unit. We understood the allocation of impairment loss to the cash generating unit. We understood the allocation of corporate asset and assessment of impairment loss, right? So now we are going to discuss the reversal of impairment loss. And it says that impairment loss recognized in last prior period should be reversed if there is an indicator that such losses does not exist any longer. You remember, I told you that impairment testing is required. Impairment testing is required when impairment indicator is there. Likewise, reversal of impairment loss will be there. Reversal of impairment loss will be there if there are reverse indicator, if there are reverse indicators. Okay. For example, in our last session, we discussed about what are the internal indicator, what are the external indicator, right? That's what we have discussed in the last class. So we said that if the market value of that asset, you remember I have taken an example of a mobile phone that on the Flipkart, after 2 year or after 1 year, the value has gone significantly down. Okay. So let's say when the market value was significantly down, it is an indicator of impairment. But what happens if there was a very low demand there was a very low supply of the raw material which was used to manufacture that mobile phone, and that is why the value of the mobile phone has gone up. If the market value is increased significantly, then it is a favorable indicator. It is a favorable indicator, and it is an external indicator of reversal of impairment. I have told you in the last class that increase in interest rate, it is an indicator of impairment. So decrease in interest rate is again a favorable indicator, which is a reversal for impairment, right? Right? Because when interest rate is decreased, your discount rate will be decreased and your value in use, present value, will go up, right? So this opposite opposite of impairment indicator is it is a reversal of impairment indicator, right? Internal indicator, your performance of the asset was going down, but now the again your asset is performing very efficiently, so again it is an indicator of reversal of impairment, right? Standard says that impairment recognized in the prior period can be reversed provided there is an indicator that such impairment loss does not exist, right? So such impairment indicator should be there. Sir, can we reverse the impairment on goodwill? Impairment on goodwill will never be reversed. Impairment on goodwill will never be allowed to be reversed. Impairment on goodwill is never allowed to be reversed, right? It is never allowed to be reversed. So friends, let me explain you that how this reversal of impairment loss will be taken into the accounting, right? So again, I'm going back to my Excel file, and then I'll come to my presentation. But let me go to my Excel file, and please confirm if it is visible. Yes. So let me talk about allocation of impairment. Let me talk about the reversal of impairment loss. Reversal of impairment loss. reversal of impairment loss, right? The first concept, please remember. And if you want to note it down, please note it down. Reversal of impairment loss on goodwill is not allowed. Reversal of impairment loss on goodwill is never allowed. You cannot reverse impairment loss on goodwill. Number two, reversal of impairment loss on other asset is allowed if there are favorable indicators. If there are favorable indicators, that's all. Sir, can you tell me the accounting treatment in case there is a reversal of impairment loss? Let me explain with the help of an example. There is a cost of an asset. There is a cost of an asset. The cost of an asset is 10,000 rupees, 1,000 rupees. Life is 5 years and depreciation is 200 rupees per annum. This is my depreciation. Okay. What is my WDV at the end of year 1? What is my WDV at the end of year 1? My WDV at the end of year 1 is how much? 1,000 minus 200. What is my WDV at the end of year 2? It is how much? 800 minus 200 again, 600. Let's say there was an impairment loss. There was an impairment loss at the end of year 2. There was a impairment loss at the end of year 2. And this impairment loss was 300. This impairment loss was 300. What is my revised carrying value? What is my revised carrying value? My carrying value is cost minus accumulated depreciation minus accumulated impairment losses. So my revised carrying value will be for the yes, my revised carrying value is equal to cost minus accumulated depreciation minus accumulated impairment loss, or I can say that 1,000 minus 400 minus 300, which is 300. Any doubts so far? Any problem in understanding what I'm explaining here? Any problem in understanding what I'm explaining here? Any problem? It is very simple. It is very simple. Right? Very simple. Friends, what is my depreciation for year 3? 2 years have already gone. The life is 5 years. What is the depreciation for year 3? What is the depreciation for year 3? Please tell me. Depreciation for year 3. What is my depreciation for year 3? Tell me. What is the depreciation? It is 300 divided by 3. Remaining life is 3 only. What is my depreciation for year 4? Same depreciation of 100 rupees. This 300 has to be depreciated over a period of 3 years. Remaining 3 years. So 100 rupees depreciation will be there. Right? What is my WDV? What is my WDV at the end of year 3 and at the end of year 4? What is my WDV at the end of year 3? 300 minus 100. What is my WDV at the end of year 4? What is my WDV at the end of year 4? 100. Are you all okay with this? Are you all okay with this? Simple thing I am doing. Simple thing. At the end of year 4, now the question has started. So far I was only discussing small stuff. Now the question has actually started. At the end of year 4, there was some favorable indicator and the value has gone up to 180. At the end of year 4, there were some favorable indicator and value has gone up to 180. What is the carrying value? What is the carrying value? Carrying value is 100. The carrying value is 100. but there was some favorable indicator and this value has gone up to 180. Of course, indicators are there. Of course, the value has gone up, right? So we need to reverse the impairment loss. But the point is, how much impairment loss needs to be reversed here? The impairment loss at the end of year 2 was 300. 300 impairment loss we have charged 2 years back. But the question arises that how much impairment loss I need to reverse today? How much impairment loss I need to reverse it today? Standard says that after reversal of an impairment loss, standard says that after reversal of an impairment loss, what is the formula given in the standard? After reversal of an impairment loss, the revised carrying value should be lower of. The revised carrying value should be lower of what? The revised carrying value should be lower of recoverable value, and had the asset never been impaired, then what would be the carrying value? Friends, after reversal of an impairment loss, the revised carrying value should be lower of. The lower should be the revised carrying value, right? Lower of what? Lower of two conditions. Number one, lower of recoverable value. What is my recoverable value? It is given in the question. The recoverable value has gone up to 180. 180 is my recoverable value. At the end of year 4, what is my recoverable value? At the end of year 4, my recoverable value is 180. But had this asset never been impaired, अगर ये ईयर 2 में इंपेयरमेंट होता ही नहीं, तो मेरी कैरिंग वैल्यू क्या होती? If this asset had never been impaired, then what would be my carrying value at the end of year 4? What would be my carrying value at the end of year 4? Friends, if this asset never been impaired, then 1000 is my cost, right? My life was 5 years. My depreciation was 200. So what is my carrying value had this asset never been impaired at the end of year 4? Cost minus accumulated depreciation for 4 years, right? Right? So what is that? 1000 minus 200 multiplied by 4. 200 would be my carrying value. Had this asset never been impaired, 200 would be my carrying value. Now, friend, please do let me know that what is lower. What is lower in this case? Please let me know what is lower in this case. Please do let me know what is lower in this case. Please let me know what is lower in this case, whether 200 is lower or whether 180 is lower. What is lower? What is lower? 180 is lower or 200 is lower? Just I need to understand that. I am asking a number. What is lower? I am asking a number. What is lower? That's all. What is lower? What is lower? Lower is 180. So what should be your revised carrying value? What should be your revised carrying value? Your revised carrying value should be 180, right? Because it is the lower value. Your revised carrying value should be 180, right? So friends, in this case, the carrying value is 100, right? And this should be 180. Which means 80 rupees impairment loss is required to be reversed. 80 rupees impairment loss is required to be reversed. What is the accounting entry? The accounting entry is, what is the accounting entry? Asset account debit by how much? 180 minus 100. 100 is the carrying value. To impairment loss reversal. How much? To impairment loss reversal, 8. This will be your accounting entry for reversal of impairment loss, right? Friends, it's not like that this 100 has become 180, right? So in case of impairment loss reversal, if I have booked an impairment of 300, I should reverse it all. No. At the time of reversal of impairment loss, you need to check what is my existing recoverable value, right? Which should be given in the question. और इफ आई वुड नॉट हैव इम्पेयर्ड एसेट, मैंने कभी भी इंपेयरमेंट नहीं किया होता, तो मेरी कैरिंग वैल्यू क्या होती? यू नीड टू कंपेयर दीज टू वैल्यूज, वट एवर इज द लोअर, that should be your revised carrying value after reversal of impairment. So in this case, my revised carrying value should be 180, and hence this is my impairment loss reversal, right? This is my impairment loss reversal. Sir, what happens if this at the end of year 4, extending this example further, or let's say taking a different number for recoverable value at the end of year 4, there were some favorable indicator and the value has gone up to 250. Tell me what will happen in this case. The carrying value is 100 and your this value is 250. Your recoverable value is 250. Then what will be your revised carrying value? Same concept you need to copy. Same concept. What you need to do? After reversal of impairment loss, the revised carrying value should be lower of recoverable value, and this. Your recoverable value is 250. Your carrying value had the asset never been impaired is 200. Your revised carrying value should be how much? 200. Accounting entry. This is 200 minus 100. I hope this is clear to all of you after giving this another example as well. I hope this is clear to all of you now. Yeah? Is it clear to all of you? Have you understood that how to reverse the impairment loss? Have you understood how to reverse the impairment loss? Whether reversal of impairment loss will be considered as a revaluation surplus? Answer is no. Answer is no. This is what you have recorded earlier. The P&L hit you have recorded earlier. Now you are reversing that. Right, friends? I hope you guys are completely okay with that. I hope you are completely okay with this. Are you completely okay with this? On goodwill, Rahul is asking, sir, whether I can reverse the impairment loss on goodwill. Answer is no, Rahul. You can never reverse the impairment loss on goodwill. Once you impair the goodwill, it will not be reversed. Okay? It will not be reversed. I hope it is clear now. Let's discuss one case study from ICAI study material on this topic. I hope my PowerPoint presentation is visible. Is that visible? On 1st April 2001, Venus Limited acquired 100% of Saturn Limited for rupees 4 lakh. Venus Limited acquired 100% of Saturn Limited for rupees 4 lakh. Venus Limited is acquirer. I am sure that you have pen and paper. Please write down. Venus Limited is the acquirer, right? And Saturn Limited is the acquiree. So purchase consideration is 4 lakh. The fair value of the net identifiable asset of Saturn Limited was 3,20,000 and goodwill was 80,000, right? So when this company acquired Saturn, the net identifiable asset fair value was 320 and goodwill is 80. Saturn Limited is in a coal mining business. On 31st March 2003, the government has cancelled licenses given to it in few states. Right? So the government has cancelled the license. There is a unfavorable indicator, and that is why impairment loss is impairment. There is an unfavorable indicator. There is an impairment indicator, and impairment assessment is required because the government has cancelled the license. Okay. In the first paragraph, we got only two information. Information number one, 3,20,000 is the value of the net assets and 80,000 is the value of the goodwill. Number two, the government has cancelled license on 31st March 2003. It means after 2 years, 1st April 2001, this company has acquired this business. So 31st March 2002, 31st March 2003, after 2 years. Okay. As a result, Saturn Limited revenue is estimated to get reduced by 30%. Due to this government action, the Saturn Limited revenue is expected to get reduced by 30%. The adverse change in marketplace and regulatory condition is an indicator of impairment. Right? We are saying that. As a result, Venus Limited has to estimate the recoverable amount of goodwill and net assets of Saturn Limited on 31st March 2003. Simple, the second paragraph saying that there is a unfavorable indicator, there is an impairment indicator, and now the company need to assess the recoverable amount of goodwill and the remaining net assets. So the second para only talks about that you need to assess recoverable amount. Third paragraph says that Venus Limited uses straight line method of depreciation. The useful life of Saturn Limited asset is estimated to be 20 years with no residual value. Means this is talking about 3,20,000 is the value of the asset and useful life is 20 years. It means when you divide 320 by 20, how much you will get you will get the depreciation every year. No independent cash inflow can be identified to any individual asset. It is saying that no independent cash flow can be identified to any individual asset. Means the entire operation of the Saturn Limited is a CGU. The entire asset is CGU. 3,20,000 is CGU and goodwill is of course part of that CGU. Due to the regulatory entangle, it is not possible to determine the selling price of Saturn Limited as a CGU. Its value in use. So fair value is not determinable, but value in use is determinable. And the value in use is 2,12,000. The value in use is given as 2,12,000. In the third paragraph, two information is given. Information number one, it is said that 20 years is the useful life. Number two, it says that the entire operation is CGU and the value in use, the recoverable value is 2,12,000. The recoverable value is 2,12,000. Right? This is what is given in the question. So first of all, I need to compute the carrying value. I need to compute the carrying value on 31st March 2003. So how can I compute the carrying value on 31st March 2003? The goodwill carrying value will be same. It is 80,000 rupees. But this 3,20,000 rupees of net assets has to be depreciated over a period of 20 years. So 3,20,000 divided by 20. This will give you per annum depreciation. What is 3,20,000 divided by 20? How much it is coming when I divide 320 divided by 20? So let me do this on Excel. 320 divided by 20, it is coming out at how much? 16,000. How much is the value? How much is the value? 16,000. 16,000. Okay. So what is the accumulated depreciation for 2 years? 32,000. So 320 minus 32 plus 80 is the carrying value, right? So 320 minus 32, you can see that in the solution, goodwill is 80,000, other assets are 320, total is 4 lakh, 2-year depreciation is 32,000, right? Your carrying value is of the CGU is 80 plus 288, 3,68,000 is the carrying value. Right? And what is your recoverable value? Recoverable value is also given in the question. It is 2,12,000. 2,12,000 is the recoverable value. This 212 is the recoverable value. So 212 is the recoverable value and my total value is 368. 368 minus 212. 368 minus 2,12,000. 1,56,000 is the impairment loss. This out of this 1,56,000, first of all, you will hit the goodwill completely. Your goodwill will become zero, and the remaining 76,000 will be allocated, will go into this other assets, right? Simple other assets. So what is my carrying value? What is my carrying value of goodwill after this impairment? Zero. What is the carrying value of other assets after this impairment? 2,88,000 minus 76,000. Is that clear? 288 minus 76. What is the value? 288 minus 76? 2,12,000. Simple. 2,12,000 is the carrying value as on 31st March 2003 for my other assets. I hope this is clear to everyone so far. I hope this is clear to everyone. Yeah. Now this 2,12,000 needs to be depreciated. This 2,12,000 needs to be depreciated over a period of how much years? Over a period of 18 years, because the total life was 20 years. The remaining period is 18 years. Simple. Now the question says, suppose by 31st March 2005, the government reinstate the license of Saturn Limited. You remember on 31st March 2003, the government has cancelled the license. But now the government has restated the license. So it means the management expect a favorable change in the net cash flow. This is an indicator. This is a positive indicator. This is a favorable indicator that an impairment loss may be reversed. That an impairment loss may have been reversed. Right? The recoverable amount, you remember, I have told you in case of a reversal of impairment loss, you need to check two things. Number one, what is the revised value? I mean to say, what is the recoverable value? Number two, had this impairment never occurred, what is my carrying value as on date? So then you need to compare a recoverable value with the carrying value. Whatever is lower, that will be your revised value, right? And to that extent, between your existing carrying value and revised carrying value, to that extent, impairment needs to reverse. It says that the recoverable amount of Saturn Limited net asset is re-estimated, and the value in use is expected to be 3,04,000, and fair value less cost of disposal is expected to be 2,90,000. So in this question, value in use is given and fair value less cost to sell is given. Friends, you have to determine the recoverable value. What is the formula of recoverable value? What is the formula of recoverable value? That is the first formula I told you in this standard. What is the formula of recoverable value? It is higher of fair value less cost to sell and value in use. So in this case, what amount you should take? 3,04,000 or 2,90,000? Higher is 3,04,000. So 1 lakh we are aware. My recoverable value is 3,04,000. Now I need to compute what should be my carrying value as on 31st March 2005 if I would have never impaired this asset, right? Have you understood this question? Yeah. So friends, what is my historical cost? Simple, 3,20,000 is my historical cost. Goodwill I will not consider. Why? Because goodwill will never be reversed. Once goodwill is impaired, it will never be reversed. So I'm not talking about goodwill. I'm only talking about the remaining assets. So what was my historical cost? 3,20,000. Had this asset never been impaired, what should be the carrying value? 3,20,000 divided by 20 multiply by 4. 64,000 depreciation should be there. So my revised carrying value should be 2,56,000. Right? And what is my recoverable value? It is 3,04,000. So which is lower? 2,56,000 is lower, or or 3,04,000 is lower. 2,56,000 is lower. So how much impairment loss? How much impairment loss I need to be reversed? How much impairment loss I need to reverse? What is the carrying value of this asset actually? Actually, what is the carrying value of this asset as on 31st March 2005? On 31st March 2003, 31 मार्च 3 को जब इंपेयरमेंट किया था तो वैल्यू कितनी थी? 2,12,000। अब इस 2,12,000 को मैंने 2 साल डेप्रिसिएट भी तो किया होगा. आई वुड हैव चार्ज डेप्रिसिएशन ऑल्सो ना. So 2,12,000 divide by 18 multiply by 2 year का depreciation, which is comes out at 24,000. So my existing carrying value is 188. मेरी आज की दिन में 188 का carrying value है, right? And what is my revised carrying value? It should be 2,56,000. My revised carrying value should be 2,56,000. Lower लेना है ना आपको. Recoverable value 3,04,000 है. आपकी जो carrying value है had the asset never been impaired 2,56,000 है. So 2,56,000 is lower and this will be my revised carrying value. But my existing carrying value is 1,88,000. So what is my impairment loss? My impairment loss is 2,56,000 minus 1,88,000. 68,000 is my impairment loss. What is the accounting entry? What is the accounting entry? Asset account debit 68,000 to impairment loss reversal 68,000. Sir, where this impairment loss reversal will go? This impairment loss reversal will go as a other income or as a negative to the other expenses, right? There it will go. Friends, please let me know if you have any doubt, any question on this particular question. Any doubt? First, I have explained you the concept with the help of Excel file, the concept. What is the concept? Then I have also covered a case study from ICAI study material so that you should be well aware about that how this impairment loss has been charged, then how this impairment loss is going to be reversed, right? Clear? Is that clear, friends? I hope it is clear to all of you. Have you understood it very well? Anisha is saying fully clear, sir. What about others? Rahul has also given a hands up. Okay. Disclosure, some disclosure requirement is there, so I'm not going with the disclosures. Okay. So now let's discuss the key differences of accounting standard and Ind AS. Before discussing these key differences, let me summarize the entire discussion we have today. Friends, when we started the standard, we understood what is impairment loss. Impairment loss is carrying value minus recoverable value is the impairment loss. If your carrying value is higher than your recoverable value, there is an impairment loss, right? Your recoverable value is higher of your fair value less cost to sell and value in use. Okay. Friends, for impairment, either impairment could be on an individual asset or it could be on a group of asset. The name of group of asset in this standard is cash generating unit, CGU. Friends, first of all, you need to identify with the help of the impairment indicator, you need to identify whether any impairment indicator is there. If it is there, you need to assess the, you need to do the impairment testing, you need to assess the impairment, okay? If the impairment indicator is not there, you are not required to perform any impairment testing. Only 3 cases are there where you need to perform the impairment testing on a mandatory basis, right? What is that? That is your goodwill arising in business combination, impairment, intangible asset having indefinite life, and intangible asset having not yet available for you, right? So we understood that concept. Then we discussed the concept of cash generating unit. What is the cash generating unit? It is a smallest identifiable group of assets where they can generate independent cash flow. And remember, we have done one example of mining activity, one example of 7 buses, one example of 3 machines, right? So this is known as a cash generating unit, right? If individual assets recoverable value cannot be determined, then you need to go to the group of assets, okay? and you have a group of assets carrying value, you have a group of assets recoverable value, you need to compare and you need to check the impairment. If impairment loss is there on the group of asset, that impairment loss has to be allocated between the assets of the group. And how to allocate? If there is a goodwill in the group of assets, first of all, impairment loss has to be completely adjusted to the goodwill. Still, if the impairment loss is still left, that impairment loss, that balance impairment loss has to be allocated to the ratio of the remaining asset, to the ratio of the remaining assets, right? Number two, if you are aware that your individual asset has a recoverable value, in that case, your impairment loss should not be lower or higher than that recoverable value of that particular individual asset in the group of assets. Okay. Friends, if there is a corporate asset like head office building, in that case, while assessing the impairment on that corporate asset, you need to allocate the corporate asset to the remaining CGUs in their carrying values, right? Then you need to compute the revised carrying value after including the value of this corporate asset in the CGU, right? Then, then friends, you need to assess the recoverable value of the CGU, right? Then in whatever CGU the impairment is there, that impairment loss needs to be allocated to the CGU excluding corporate asset and corporate asset. This is how you will compute the revised values. Whatever revised value will come for the assets, the prospective depreciation and amortization will be on the basis of the revised values, right? Then we discussed the reversal of impairment loss. The reversal of impairment loss on goodwill is prohibited. But on the other asset, even the reversal of impairment loss can happen in subsequent years, right? Only when the favorable indicators are there. If favorable indicators are there, you can reverse the impairment loss which you have booked earlier. But your revised carry should be lower of your recoverable value and should be lower of your recoverable value and your carrying value had the asset never been impaired, right? So your revised carrying value should be to that extent only, right, friends? So this was all about Ind AS 36, which we have explained with the help of concept, examples, and case studies. Okay, friends? So let's quickly discuss the difference between AS and Ind AS. So in AS 28, it does not apply to the financial asset, but Ind AS 36 applies to financial asset like subsidiary, associate, and joint venture. So a specific guidance is given. So there is no extra treatment or something. Such guidance is given. In AS 28, it does not exclude biological asset, but it excludes biological asset. Just a theoretical guidance, right? Goodwill is tested for impairment using bottom-up or top-down approach. Here, goodwill is allocated to CGU. So almost same concept is there, just a theoretical difference is there, right? Yes, this is the big change. In AS 36, it does not allow reversal of goodwill, reversal of impairment loss on goodwill, but in AS 28, the impairment or loss on goodwill can be reversed if there are some favorable condition. Okay, so in that case, it can be reversed. Okay. If I talk about the annual impairment test for intangible asset and goodwill in accounting standard 28, it does not talks about for those exceptional asset. It says that the goodwill and other intangible are tested for impairment only when there is an indicator of impairment. But in Ind AS 36, goodwill, intangible asset not yet available for use, or intangible asset with indefinite life is required to be tested for impairment on an annual basis, right? We discussed the objective and scope of Ind AS 36. We discussed that how to identify an asset that may be impaired. We discussed how to measure recoverable amount, fair value less cost to sell, and value in use. We discussed the recognition and measurement of impairment loss. We discussed the concept of CGU, allocation of impairment loss, allocation of corporate asset, reversal of impairment loss, and the disclosure requirement. Right. This is what we have discussed in detail in Ind AS 36, friends. Friends, please do let me know if you have any question on this Ind AS 36. I have done the revision 2 times. I've explained 2 times. Have done the full revision, right? Have explained all the concept. Please do let me know if you have any doubts so far. I'll wait for another 30 seconds. If there is no questions, session. Let me know if you have any doubt. Tanisha is saying super understood, sir. Thank you, Tanisha. What about others? Have you understood or you haven't understood? Understood. Okay. Thank you, Rahul, for such a nice feedback. Thank you so much. Okay, friends, if you don't have any doubt, let's conclude the session. And thank you so much for wonderful and patiently listening this standard. I will share the Excel file and the PowerPoint presentation today itself, and probably it will be uploaded on the portal today or maximum by tomorrow. Thank you so much. Stay safe, stay happy. Bye bye. Take care.